Welcome to this financial accounting and reporting class. My name's Kieran. I'm a senior tutor at ACA Masters. When I sat the ACA exams myself, I won ICAEW prizes for financial accounting and reporting, tax, audit, financial management, business strategy, and case study, including the highest score in the world. I now teach learning strategies and exam techniques behind this success to my students so that they can achieve similar levels of success. In this class, we'll be focusing on assets, and I'll firstly teach some of the key technical content in an easy to understand, simplified way. I'll then work through some exam standard questions so I can demonstrate the exam technique that you should use when answering the explain the IFRS treatment style questions in the exam. So we'll be looking at a question 2 where we have to explain the IFRS treatment. So once I've explained that key technical content, I'll be working through questions so that I can demonstrate how that technical content is applied in the exam, and most importantly, the exam technique you should use when answering questions. So when we're looking at assets, it's important to keep in mind the definition of an asset. So an asset is a resource controlled by the company as a result of past events and which has the potential to produce future economic benefits. So useful to keep this key criteria in mind. It is very abstract, but if we think about a few examples, so a classic example of a resource which is treated as an asset would be land and buildings, plant and machinery, fixtures and fittings, equipment, motor vehicles, etc. So those would all be assets because they're controlled by the company. The company can decide how those assets are used and for what purpose. They can direct how that asset is used. There'll be a result of past events if the company has previously purchased those assets. And there'll be future economic benefits if they will be used to sell goods and services in the future and therefore generate cash coming into the business. Alternatively, they can be used to reduce an expense, so to reduce an outflow from the business. So it's important that the company is able to control the asset, and that's why we wouldn't recognize an asset for employees because they cannot be controlled by the company. They could leave the business. They have to be a result of past events. So we couldn't recognize an asset for expected future expenditure in buying an asset in the future. And they have to have the potential to produce future economic benefits. So there have to be some cash inflow coming from this asset in the future or a reduction in a cash outflow. So therefore, if the company does have an asset, then it will be included in assets on the SFP. So if it's classified as property, plant and equipment, so assets used in the day-to-day normal activities of the business, then it will be under this subcategory of assets, property, plant and equipment. So if we contrast this with an expense, so similar to an asset, a company may have gone out and incurred some expenditure. So they may have purchased something and paid cash out. So therefore it would be crediting cash, or if they've purchased it on credit, then there'd be a trade payable. However, if the definition of an asset isn't met, rather than debiting asset, we would instead debit expense in the P&L. So an example would be something like a bill, perhaps a utility bill. So if they've just paid a bill for a service they've already used in the period, then there'd be no future economic benefits. If they've paid out for a service that they've used in the period, then that will just be recorded as an expense. Whereas if they've purchased an asset and it meets the definition of an asset, then we can see here that we'd record this as an asset. So it's quite similar in that you'd credit cash or credit trade payables because the company's paid cash out or it owes some money. The question is, what have they purchased here? Have they acquired an asset? And therefore we meet the definition of an asset and it's capitalized on the SFP, or is it just an expense and therefore it's written off against profit in the current period? So we'll now look at an exam question. So it's very common to see assets examined, not just in financial accounting and reporting exams, but also corporate reporting and strategic business management. So whenever I attempt exam questions, I always look at the requirement first of all, because I like to know what I have to do, because once I know what the requirement is, I can then read through the scenario, read through the question much more actively. And also, having looked at the requirement, I can then start to think the best way to go about tackling the question. So we can see here, explain the IFRS treatment, so explain the financial reporting treatment of issues 1 to 5 above in the company's financial statements for the year ended 31st of December X2. Always nice when it's a December year end, it's often easier to prorate if we have some prorating to do. You should prepare all relevant calculations and set out the required adjustments in the form of journal entries. So read the requirement very carefully, because not all questions ask you to set out the journal entries. So you don't want to waste time setting out the journal entries when you don't need to. And perhaps more importantly, you don't want to forget doing the journal entries when the examiner has specifically asked you to do it. So again, another reason why it's really important to read the requirement very carefully, because you'll be able to identify everything you need to do. Reading the question is very important. To calculate the following revised figures for the company's financial statements for the year. So revised figures for profit before tax and total assets, and there's 5 marks for this. So you could think about your time allocation here. Now, certainly for the question as a whole, we could work out how long we're going to spend on this question by taking our minutes per mark and multiplying it by the number of marks. Now you can see here that we've got a number of issues. So the best way to approach these types of questions is to take one issue at a time and do everything you need to for that issue. Because if you look here, we need to explain the IFRS treatment for each issue. So issues 1, 2, 3, 4, and 5. But we can see we need to redraft some figures from the financial statement. So profit before tax and total assets. So we can see that we've got some figures here. So this question presumably won't have ethics in it because it's a very short introduction to the question. You'll notice the ones that have ethics in usually have a much longer introduction to the scenario, telling us who we are, who we work for, etc., because that usually includes the ethics issue. So we've got a nice short one here where we're just told the following matters need to be dealt with in the financial statements. We're told what the draft profit is, and we're told what the assets were, and we know that we need to get to revised figures for both of those. So you can see that what we're going to need to do is we're going to need to read note 1. We're going to need to explain the IFRS treatment for note 1. But the impact of note 1, so any adjustments we propose, are also going to result in an impact on the profit and also possibly on the assets. So you can see, when we go through note 1, whatever, note 1 is about, acquiring an asset, for example, we need to explain the IFRS treatment, and we'll go through the technique for that. So we need to answer this part, but also whatever happens in note 1, whatever adjustments we propose, it's also going to have an impact on what we have to do for part 2. So actually, if you treat this question as one and take each note at a time, explain the IFRS treatment, but then immediately after overlay your numbers, it will be quicker overall. And I'll demonstrate why as I work through the question. You'll see this more clearly as I work through. But once you've kind of embedded yourself in note 1 and whatever it's on, it makes sense to do everything you need to do for this note. rather than just explaining the IFRS treatment for note 1, then explaining it for note 2, note 3, etc., and then getting on to the next part of the question. Oh, I need to redraft the financial statements, because then you're going to have to go back through all of the notes again to remind yourself, oh, what was the adjustment? What was the impact on profit? What was the impact on assets? And you'll kind of spend time, transitioning back through the notes, where it's much quicker overall if you do everything you need to for that note at once. And I'll demonstrate this now, as we go through. So the first thing that I would always do would be to set up the draft profit for the year. We know the key numbers that we're looking at here is profit and assets. So anything which is going through the P&L is going to have an impact here. And then we're looking at assets, the total figure there. So we've got the draft profit for the year, which is 611,000. And then we've got the assets, which are 1.55 million. So we've got our draft numbers there, and we know highly likely that each note, so note 1, 2, 3, 4 and 5, will have an impact on these. Maybe they won't all have an impact. Maybe they only have an impact on assets and not profit, perhaps. But we'll see. So what we need to do is explain the IFRS treatment for each note, so we can work through each note in turn, explain the IFRS treatment, and then overlay any numbers we need to our draft financial statements. So in this first note, we're told that on the 1st of July X2, so of course we're looking at the year ended 31st of December, so we can see halfway through the year, the company began constructing a specialist piece of plant. So therefore that certainly sounds as though it's an asset, unless we're told otherwise. So they were constructing this asset. The plant underwent a final safety inspection on the 30th of September and was ready for use the following day. Now that is a key point in time when the asset was ready for use, because that's when the asset starts to be depreciated from. So certainly look out for that in exam questions. So the plant has a useful life of 10 years. Again, that's important because that's a period that we're going to depreciate the asset over. So you can see here that clearly this is a resource which has the potential to produce future economic benefits, because they're going to use it for 10 years, presumably to make the goods that they are selling. Although a motor unit, which costs 12,000, will need replacing every 5 years. So we're told this piece of plant will last for 10 years, but there's a specific part of it which will only last for 5 years. So we'll think about how that impacts the depreciation charge when we get there. At the end of its 10-year useful life, the plant will be scrapped for £500. So it sounds like it has a residual value. So when it gets to the end of its 10-year life, they will get some money for it. So we'll think about how this feeds into our answer. So we're told no depreciation was recognised for the year ended, so the year we're looking at, as plant was not working at its full capacity because staff were still being trained. So we're being told that they haven't recognised any depreciation on the basis that staff are still being trained, presumably on how to use it. However, we know that the asset is depreciated when it's ready for use. So it's quite often that they've made some mistakes in the accounting treatment. So the following amounts were incurred between the 1st of July X2 and the 30th of September X2. So that's when they started building it. This is when it's ready for use. So up until the point it was ready for use, the following amounts were incurred. So therefore we need to think, are these assets or are these expenses? And we're told they were capitalized as part of PPE. So these are all recognized as part of the asset. And we've got a list here. So we're not just told what the plant costs, we've got the materials for the plant, which they built it, including that motor unit, which cost 12,000. So we know how much the materials cost excluding that. Labor costs to construct it, so to build it, because it was an asset which they constructed in-house. They didn't just buy the finished item. staff training on how to use it efficiently, consultancy fees regarding installation and assembly, a safety inspection, and some allocated overheads. So the issue we have here is we've kind of got the cost of the plant, which is like the materials and the labor. That's what it kind of costs to build it. But then we've kind of got these other costs as well, like safety inspection, staff training. So it appears as though the plant is definitely an asset, a resource controlled by the company. They can decide how it's used as a result of past events. They've already built it, and there's going to be some future economic benefits because it's going to last 10 years. So it's pretty clear that there's an asset there. The issue we have is which of these costs is actually included as part of the asset, and therefore which costs have to be expensed. So under IAS 16, you can capitalize as part of PPE the cost of the asset itself, but also any costs which are directly attributable to bringing it into working use. This is very important, directly attributable to bringing it into working use. So what this really means is costs to obtain the asset and to make it work. The costs you had to incur in order to kind of construct that asset, to get that asset in, to get it working so that it can be used. So this also includes any interest costs on loans to construct the asset. We'll briefly talk about that later, and we'll see that in other questions in later classes. Costs are capitalized when expenditure is incurred on the asset and work begins to construct it. So we've just related to that interest point. And then you could also capitalize as part of the asset any dismantling costs, but we'll look at that in the provisions class. So it doesn't appear as though we're told about any dismantling costs, so that isn't relevant here. So we're looking at the cost of the asset and any costs which are directly attributable to bringing it into working use. Now we're saying that's what's capitalized as part of the asset, and anything else is expensed. So any costs not meeting the definition of an asset. So for example, when he repairs, so it's unlikely they need to repair it now, but in the future, if they have to repair it, then that isn't going to produce additional future economic benefits above and beyond what the asset was already going to produce. That's just a normal repair, so that gets expensed. And as you said, future expenditure is not a past event. And clearly, if we're saying here that costs which are directly attributable to bringing the asset into use, obviously costs which aren't directly attributable to bringing it into use would be expensed to the P&L. So like I said, when you incur some expenditure, you have to think, is it an asset or is it an expense? And therefore, that definition of an asset is useful, but important to remember that you can also capitalize any costs which are directly attributable to bringing it into use. So in this question now, you might be looking at this and you might be thinking, oh, well, these costs are definitely directly attributable because it had to be installed and assembled. So the first thing I'm going to type is these should be capitalized as part of the asset. So yes, whilst that would be correct, we have to appreciate what this question is actually asking us. It isn't just saying state the IFRS treatment or calculate the impact on the financial statements. It's saying explain the IFRS treatment of these issues. So we need to explain it. And this is an important role of an accountant, quite often to explain things to people who aren't accountants. They've usually got some financial knowledge, but they might not be accountants. This is a really important skill, and we need to be able to explain the treatment. So a really good way for approaching these types of questions is to firstly briefly mention the relevant parts of the relevant standard. So we can think, okay, well, what's the relevant standard here? Well, as we've already said, we're looking at IAS 16, so that's PPE, property, plant, and equipment. So we could briefly mention the relevant parts of the relevant standard. So we could say, under IAS 16, now if you don't remember the exact standard number, you could put IFRS, or if you're doing a UK GAAP exam, UK GAAP. So under IAS 16, so you could briefly mention, what the definition, of an asset is. So you could say an asset recognized if resource will be controlled by a company as a result of past events and future economic benefits. And you could even use an abbreviation like that. I'm sure the examiners would kind of know what you mean there, particularly in the context of that sentence. So you could briefly start with the relevant parts of the relevant standard, and then we could say the amount capitalized as asset is cost of asset and any directly attributable costs. You know, that's the key thing that we're looking for here. That's kind of the key principle that we're looking at here. And you could say, you know, other amounts are expensed to P&L. Again, a fine abbreviation to use there. So any abbreviations you see me using will be fine to use in your exam to help you save time. As long as it's quite clear, the examiners should still give you the credit. So therefore you can see we just briefly started with the relevant parts of the standard. Now, it's important to not get this confused with just kind of dumping lots of knowledge, you know, from the IFRS book. I've kind of selectively thought about which parts of the standard are relevant. I haven't talked about everything in IAS 16. I haven't talked about the cost and the revaluation model and, you know, disposal of an asset and things like that. I've talked very specifically about what amounts are capitalized and what happens to amounts, you know, which aren't meeting the definition of that asset, because that's what this question is kind of getting at. That's kind of the subtopic we're looking at here. We're looking at company has firstly acquired an asset, so they've acquired an asset. What costs can they capitalize? And that's what the question is getting at here. So I've been very selective about the bits of the standard I've mentioned here. So that isn't the same as just thinking I can just copy out lots of general abstract parts from IAS 16. I mean, very selective here, because the next part is to then apply that knowledge to the scenario. And we can explain as well why their current treatment is wrong. So think of like that's the first part to your answer, relevant parts of the relevant standard, 2, maybe 3 points, is enough there. But then the next bit is to apply it to the scenario. So you could briefly mention, that the plant is an asset. Maybe this bit is a bit too abstract, but certainly saying what, should be capitalized. So we can now apply this to the scenario and say which costs are directly attributable and which aren't. So the materials, so in order to get this piece of plant up and working in the factory or wherever it is, obviously they had to buy the materials which made up the plant. Obviously they had to have the labor cost to construct it, because to get the asset and to make it work, it obviously had to be constructed. Now, staff training on how to use it efficiently, that isn't necessary to get the plant constructed and to get it working. Teaching staff how to be more efficient with it isn't really directly attributable to bringing it into working use. Just to get it up and working, you don't need to show staff how to use it efficiently. So that cost wouldn't be capitalized. So then we have consultancy fees on the installation and assembly. So again, the plant needed to be installed and it needed to be assembled in order to get it working. So that cost is okay. Safety inspection, there need to be a safety inspection to make sure that it was safe to use. There's probably like a legal requirement that has to be done before you're allowed to use a plant, before you're allowed to turn it on. And then we've got allocated overhead. So I mean, the term overhead sounds as though that isn't going to be kind of directly attributable, but we're told here that 30% is general admin. So you've kind of got general admin staff working in the business, and some of their costs has been allocated to perhaps each asset. But that isn't directly attributable to bringing the asset into use. It's just general kind of payroll staff and admin, HR, etc. So then we've got 70%, which is directly attributable. So that's obviously the key term we're looking for. So they're saying 70% of these costs are directly attributable to bringing the asset into use. So those could be capitalized. So therefore, when I say we apply it to the scenario, we're taking this kind of technical content and then we're applying it to the specific scenario. So you could say the staff training costs. It's probably easier to say the costs which aren't directly attributable rather than the ones which are, because there's less of the ones which aren't directly attributable. So the staff training on how to use efficiently and general overheads are not directly attributable as we're not required to get plant working. You know, these costs should be expensed. And then you could say, you know, other expenditure is directly attributable. Again, you could have kind of applied that first bit and said, you know, the plant is a resource. They're going to use it over multiple periods because they're going to use it over 10 years. They could possibly have had that point in there as well. But we've obviously got the kind of the depreciation issue to deal with here as well. So it's kind of quite a bit to do here on this question. So once we've done that and you've applied it to the scenario, the next bit to do, we could say why their treatment is incorrect. So kind of we said that there because we've already said staff training not directly attributable. These costs should be expensed. We could say and should not have been included in PPE. So then we can say what's the impact on the financial statements. So what's the impact on the various financial statements, and we can set out the journal entry. And then if we need to for the next part, we can correct the draft statements. We can go back to those draft profit numbers, back to that draft asset number and correct those. So with this question, what we're probably looking at doing here is, you know, recalculating what would be recognized as an asset and what would be recognized as an expense, because it was incorrect to recognize all of these. So you should be able to copy this over to the spreadsheet area so that we can do our workings. Alternatively, there would be a kind of a shortcut method that we could use to do this calculation, because you could just take the total and then minus off what shouldn't have been capitalized. But we've got these amounts here, so we know that some of it is going to be treated as PPE, some of it is going to be treated as an expense. So we've said that yes, the materials cost, that's definitely PPE, labor is, staff training should be expensed, consultancy, yes, safety inspection, yes, these are all directly attributable. These overheads, it was, yeah, we've got it here. So the overheads was 70-30. So we've got 30 here for the general and 70 there for the directly attributable. So 70% would be PPE. So we'd have 70% there and we'd have 30% here. And therefore you can see what should be expensed to the P&L because they're not directly attributable, and what would be capitalized as part of the asset. And you could just sense check that and make sure you kind of got the full amount here that we had in the question, and just make sure that you've copied everything over correctly and you've got to that full amount. Alternatively, you could have just started with the total of 140k and minused off the two amounts which should be expensed to get down to the PP amounts. Different ways you could do it. But this would be one way. I'm just showing you this as well for tutorial purposes, perhaps the most comprehensive way. So we can see what would be expensed to the P&L and what would be capitalized as part of PPE. So of course, we'll be able to copy that over into our area here when we're ready. Now, of course, we're told when the asset was ready for use. We've thought about, first of all, when you first incur expenditure, we've thought about what's recognized as an asset and what is expensed. So that's like the initial recognition. When you first incur that expenditure, what do you initially recognize as your asset? And we've been through that there. So we've got our asset on our SFP. So then we need to think, how is it accounted for after that date? So we've got our asset here of whatever we've worked it out as. So that's our asset there. This all just gets expensed to the P&L. But once we have our asset, how do we account for our asset going forward? So what's a subsequent measurement? Well, there's two models. So there's a cost model and there's a revaluation model. Now, we're not told which model they follow. Now, if they're following the revaluation model, you'll usually be told that in the question, or at the very least, you'll be told what the fair value is at the year end. So we're not told about that at all. Now, what we are told is, of course, some information about depreciation. So under both models, you depreciate the asset. So it's depreciated over its useful economic life, and it's depreciated once it's ready for use. So another key term there, like directly attributable was a key term here. Ready for use is really important because that's when the asset is depreciated. Now, each component is depreciated separately. So you remember depreciation from certificate level accounting. So I'm sure you're all very comfortable with that. You know, land isn't depreciated because its useful economic life is deemed to be indefinite. And we review these amounts every year as part of our accounting estimates. So therefore, we know that it's depreciated once it's ready for use over its useful economic life. So we've kind of got a second part to this. So again, you could have had this in your abstract bit, the relevant parts of the relevant standards, but you could say, assets are depreciated once ready for use, or you say depreciated over useful economic life once ready for use. But putting that ready for use in is really key there, because that's the bit we're going to look at here. So we could say plant should be depreciated from when was the date it was ready for use, the following day, 30th of September was the safety inspections. So it should be depreciated from 1st of October X2, as this is date ready for use. So you could say, therefore, 3 months depreciation in, current year. So you can see again what we've done here. That's a relevant part of the standard. Assets are depreciated once ready for use. But here's where we're applying it. So plant, that's the specific asset. Depreciated from this date, that's the date it was ready for use. So we're just applying this technical knowledge to the scenario, just as we did there. So therefore, we're quite clear here of when it should be depreciated from. So the other bit is, the separate components. So we're saying here there's a separate component and that should be depreciated. So each separate component should be depreciated over its own useful life. So we can see here that the motor unit, whilst the plant has a 10-year useful life, the motor unit needs replacing every 5 years. So we can say, motor unit needs to be depreciated over its 5-year useful economic life, whereas the plant will be depreciated over 10 years. And we don't always have to have every kind of technical point. You could just start kind of putting these in now, particularly when we think we're doing really well here. So we're probably getting lots and lots of marks, and there's usually more available marks and maximum marks in these types of question. And if we could briefly explain what they've done wrong. So they didn't depreciate it because staff are still being trained. So you could say, incorrect, not to depreciate as, so we were told not working at its full capacity, as capacity not relevant to depreciation period or start date. You depreciate the asset when it's ready for use, not when it's at full capacity. So it's important to kind of point out there where they were incorrect. You definitely get a mark for that as well. So then we get to the numbers, and this can get quite fiddly at times. So that's why it's really good if we've got plenty of our points down for the explaining bit, because we've got plenty of marks here. The numbers can get quite tricky because we've got this PPE now. We know we need to depreciate it. We've kind of got different parts to it because we know that we've got the motor units, which cost 12K. So this is like the motor part of the asset. And then we've got, the other or the remainder. So 12K related to that. So the other bit of the asset, must be this. And then we can think, okay, well, what period are we going to depreciate it over? They've got a 5-year useful life. But of course, we've got the residual value as well we need to take into account, because this has no residual value. So you've kind of got the cost here. Then we think about the residual value, because you don't need to depreciate the full amount because you're going to kind of get some back. Now, we're not told about any residual value for the motor units. They need replacing every 5 years. So presumably they're worth nothing unless we're told otherwise. Now, we're told at the end of its 10-year useful life, the plant will be scrapped for 500. So that's kind of the 10 years. So presumably the motor units would, there'd be nothing left of those. But, the other plant would be scrapped for 500. So therefore, we can see the amount we need to depreciate for the plant would be this. We'd have the cost here for the motor units minus what they're going to get back from selling it in the end. So this is the amount which is depreciable. This is the value that the company is going to use up over that period. So the plant will be used over 10 years. The motor units would be used over 5 years. And therefore we can see that's the depreciation each year. But of course, we only want 3 months of depreciation. So you could divide by 12 times by 3, or perhaps easier would be to divide by 4. You could just do that and then drag that formula down. So therefore, we've got the cost of our PPE. So we know what it costs originally, what we should capitalize as part of PPE. We'd have our depreciation. So this is writing off the cost of that asset over its useful life, because the company paid money out to acquire this asset. And what we've said is this isn't an expense. We're going to recognize it as an asset initially because it's going to be used over multiple periods to produce future economic benefits. But it's initially cost this. Eventually, in 5 years or 10 years, 10 years it's worth this. So therefore, you can see there is that fall in value. They are using up that value. So we record this as an expense over the period it's being used. So with the plant, for example, this is what it's currently worth. That's what it cost. We're not recognizing as a cost in the P&L, now. We're going to recognize it as an asset initially, but it is a cost over those 10 years because it goes from being worth this to this. So this is the amount which is effectively a cost. You've got something which costs you this, you're only going to get that back for it. So this is your cost of owning that asset, but you're going to use it over 10 years. So therefore, we're going to record that cost over 10 years. And that's the accruals concept. We're recording that expense over the period in which it's going to be used and the period in which it's going to be used to earn income. Presumably, it's going to help the company earn income over those 10 years. So we record the cost of that plant over those 10 years. So hopefully you can see with that relatively simple example, how we're using the accruals concept there and how depreciation is an example of the accruals concept. We're matching the cost of this plant with the income it's going to generate, over those 10 years, because it's going to be used for those 10 years. So therefore, we've got the total cost of our plant. This is the depreciation. Fiddly calculation that, with the residual values, if you made a small mistake, it wouldn't matter, particularly with this, even if you didn't have the residual value in there, you could still get full marks for this question because there are more available marks than maximum marks. Don't worry about fiddly little points like that. Even if you depreciated it all over 10 years, or even if you didn't do the 3 months because you're in a rush and you kind of forgot, there's more available marks than maximum marks. So typically in these types of questions, there might be like 50 available marks. So therefore, if you got all 50, you'd only get 32. Whereas you could just get 32 out of the 50 and therefore miss 18, but still get full marks. So even if you make a few mistakes on the way, it doesn't really matter. The key is really to get all the easy and the medium marks, because that'll get you up to the full marks. And they're like the low-hanging fruit. So grab all of those easy and medium marks and don't get sucked into these really hard bits, like realizing, I should have prorated it, and then coming back to it and fiddling around with it to get it exactly right. Because it's probably likely the case if you've done all of the other bits, you've already got full marks. So actually, by getting this bit correct, if you've already got full marks, you're not even getting any more marks. So what you're doing may as well be wrong because you're doing something and not getting any marks for it. So that's how you have to think about your exam technique. Get those easier medium marks and don't always worry too much about the hard bits, like perhaps that depreciation calculation. So you can copy this over into the word processor area. So you'll have that there in your word processing area, so the examiners will be able to see what you've done there. So we've got the cost, we've got the depreciation, and then we've got the carrying amount at the year end. So that's all kind of quite clear. Everything's labelled up, PPE, P&L, you can see everything here, what we've done here, clearly that's a depreciable amount. And they can see exactly, what we have done here. So we started off with the relevant parts of the relevant standard, applied it to the scenario, explained why what they have done is incorrect, and then calculated the numbers, as we've said, is our kind of ideal exam technique. Now we had to do the journal entry here because this question specifically asked for it. So let's think about the journal entry here. Well, we've got a couple of journal entries because we said they should initially have recorded those expenses in the P&L, and these were recognised as part of PPE. So they should have been expensed. So they should have been expensed in the P&L. So therefore we'd have debit P&L, and the other side would obviously be credit PPE because they've recorded it as PPE and they shouldn't have been. So the asset's too high, so to reduce the asset, credit it, and then debit the P&L to record the expense. So that's the first entry that we needed. And then the next one is just a depreciation because you then have the right amount of the asset because that's what they had as an asset. We reduced it by 15,100. So we've got the right amount of the asset, and then there's this just a depreciation charge. So you could just say here, incorrect capitalisation. That's what they've done there. And then for this part, depreciation, current year expense, and that would obviously be debit P&L, credit PPE, because we're writing off the asset over its useful economic life. And then it's kind of quite nice to say at the end, what the final year-end balance is. So carrying amount at year-end or at the SFP date would be this. You could put the 31st of December in there. And that's what a good answer to an explain the accounting treatment question looks like. Relevant part of the relevant standard, apply it to the scenario, calculate the numbers, including doing the journals if you have to. And it's really good to say kind of why what they have done is wrong if you can. Now, rather than going on and jumping onto note 2 now and looking at whatever we have to for note 2 and bearing in mind that in your exam, obviously every issue isn't going to be on assets. This next one might be financial instruments or provisions or revenue, and jump into a completely new topic, maybe even something on groups. What we want to do before jumping on and throwing ourselves into this next topic, instead, if we do the next part of the question now, it's going to be a lot easier because we know that for the next part of the question, we have to redraft the profit and the assets number. So if there's anything from note 1 which impacted profit or assets, it makes sense to just do it now because it's fresh in our head. We know exactly what impact everything has. We know that we need to reduce profit because those should have been expensed. We know that also reduces assets. And we know we've got the depreciation charge as well, which will reduce profit because no depreciation was recognised in the year, and also reduce the asset. So it just makes sense to do that now. This is fresh in our head. We know exactly what needs to be done. We've said, what impact it has. If we have to adjust the profit or have to adjust the assets or have to adjust, retained earnings, then it makes sense to just go and do that now. You could even kind of label these up briefly if you've got time, incorrect capitalisation or depreciation. But it'll be very clear to the examiners because we set it out here, so probably no need to do that there. So hopefully you can see how it makes sense to do this second part of the question now, rather than kind of going through all of these other issues. And by the time you get to issue 5, you'd have forgotten what issue 1 was about. And therefore, you're going to have to come all the way back through your answer. I mean, this question might not be too bad because we've got the journals. But if you didn't have the journals, you'd have to start trawling through these numbers again, trying to work out what impact everything had on the profit and the assets. It would just be much more time consuming overall than it was to just quickly drop those numbers in straight away. In note 2, we're told that the company constructed a new freehold factory which was ready for use on the 1st of January X1. So that's the start of the previous year because we're looking at the 31st of December X2. And we're told how much it cost. So it's a freehold factory. So freehold means they own the land as well as the building. We know the date it was ready for use, so we know when it should have been depreciated from. So the building would be depreciated, but not the land, because land has an indefinite useful life. It's never used up. So the land and building cost, and we're told the two amounts respectively. So we know what the land cost, 425k, and we know what the building cost, which was 150k. So therefore you can see the total together. So broken down between land and the building. And we need to know that because the building is depreciated, but the land isn't. The building had a useful life of 50 years, so that's why we're told that, so we can depreciate it when it was ready for use. So we're going to depreciate it over 50 years. We're not told about a residual value, so unless we're told about that, we'll assume it's 0. The directors decided to measure freehold land and buildings under the revaluation model. So we said there's 2 models that you could follow for each class of asset. So not for PPE altogether, you can break it down by class. So therefore, freehold land and buildings could follow the revaluation model, and plant and machinery could follow the cost model. And that's an accounting policy choice. So we're told here that they've decided to use the revaluation model for freehold land and buildings. The value of commercial property has been increasing, and an independent expert valued the factory at 720k. So clearly it's gone up in value at the start of the current year. And again, we're told the breakdown between land and buildings. We know the total, we know land, so therefore we can work out the valuation of buildings, 170k. And you can see, buildings have gone up in value, and of course the land has gone up in value as well. Now we're told the directors would like to make annual transfers between the revaluation surplus and retained earnings. We'll think about what that means. So as you said, once a company has an asset, and you can see here clearly that's an asset, it's a factory, it's going to be used over multiple periods, it's going to deliver future economic benefits because this factory is going to be used presumably to produce goods and services. We know what costs were capitalized, we've got an asset. Now, we're not given a list of costs which were capitalized, we're just told kind of what they cost. They may have just kind of purchased them complete, and these were the only 2 costs. They purchased the land and purchased the building, perhaps purchased them together. So we're not looking at here at initial recognition, what should the asset be recognized and which costs can be recognized. We're told, it's a previous year, this is what was recognized as an asset. It doesn't appear to be anything wrong here. So they've capitalized the asset on the SFP. So therefore they'd have the land and the buildings when they first acquire them. Then in that first year, there would have been some depreciation on the building, and that would of course reduce the value of the asset. So we'd start the current year with the asset at its original cost minus that 1 year of depreciation on the building. Now we're told they measure freehold land and buildings under the revaluation model, and that's fine. That's an accounting policy choice. You can choose which model to follow, but all assets of the same class must follow the same model. So therefore, they must measure all freehold land and buildings under the revaluation model. Now, we're not told here that they're not doing that. Perhaps we could mention that as a point, but that doesn't seem to be something that is the main part of the question here. So if we're under the revaluation model, then similar to the cost model, you capitalize the costs which are directly attributable to the asset, the cost of the asset itself, and then it gets depreciated over its useful life when it's ready for use, just as like the cost model. But the asset is then revalued to fair value. So think of fair value as what the asset would sell for in an open market. So almost like what is the market price, the open market price for this asset. We'll look at fair value in more detail in corporate reporting, but for the purposes of the FAR exam, then that's just like open market value, what the asset is worth if it were to be sold. So if its value, if its fair value is higher than its carrying amount, then we'll increase the PPE up to fair value. So we'll increase PPE by debiting PPE. Now the credit, so we've got an increase in an asset here, so usually that would result in a credit in the P&L, but the credit is recorded through other comprehensive income. So you can kind of think of the income statement as being divided into 2. You kind of got like the profit and loss, and then you've got other comprehensive income. So they're both like income statements. This is where we record income and gains for the year. It's just certain types of income and gains are recorded through other comprehensive income, and it tends to be items which are more unusual or abnormal. So for example, revaluing your property. Now, if you revalue your head office and you have a big gain for that, then if you were to record that in the P&L, which records normal trading activity, so selling the goods and services that the business provides minus its costs of providing those goods and services to get down to like its operating profit, if you recorded this gain on revaluing your head office, then that could really distort the P&L. So this company could have had a very average year, but if they record a huge gain because the value of their head office has gone up by a significant amount, so over 140,000, so 145,000, then that is going to inflate the P&L. So therefore, we record income and gains which are perhaps abnormal, unusual, and don't relate to normal trading activities, so the buying and selling of goods and services in a normal course of business. We record those items through other comprehensive income, really so as to not distort the P&L. But we'll see a few more examples of items which go through other comprehensive income at corporate reporting. I mean, some of this is a bit of a contentious area about what should be recorded through here and what should then be recycled to the P&L, but we don't need to worry about that at this stage. So think of it for the purposes of the FAR exam, gains on revaluing property is recorded through OCI because it's a bit more abnormal, a bit more unusual, and it doesn't relate to day-to-day trading activities. So we'd record a gain through other comprehensive income. So therefore you'd have an increased asset because we've increased the asset up to fair value. The gain is recorded through other comprehensive income. So if you think about what happens then going forward, we now have a higher asset amount. So we have a higher carrying amount for our asset is increased in value. So if the asset has increased in value, then as a result, there's going to be more depreciation because you have to depreciate the carrying amount over its useful life. If your asset has a higher value, but it's got the same useful economic life, you're going to have higher depreciation because you've got the value of your asset, you have to still depreciate it. So the building over the 50 years or whatever's left now, so 9 years. So then we'd have the depreciation going through the P&L, but that's now going to be higher. So actually the impacts of revaluing your property, all of the benefit, the increase in value went through the OCI. Basically, because you've got the higher asset amount, you're going to have higher depreciation, and depreciation is recorded in the P&L. So if it's recorded in the P&L, then the impact is going to be that profits are going to be lower because you're going to have more depreciation. So actually the P&L kind of suffers from a revaluation because the impact on the P&L is more depreciation because the asset's higher. And the OCI benefits because the gain, the upside of the revaluation is recorded through here, but the additional depreciation, which arises as a consequence of that, is recorded through the P&L. So if you think about what impact this has, now remember the profit for the year ends up in retained earnings. At the end of the year, the profit that the business has made, now that gets transferred into retained earnings. Retained earnings is the cumulative profits. It's retained earnings from the previous year plus the current year profit. So, in the first year, all it is, the profit for the year. It's just the total of profits from all of the previous years, minus by any dividends which have been paid. So other comprehensive income, the income and gains from other comprehensive income go into their own separate reserve in equity. So again, these are income accounts. The mechanics of accounting are, we've recorded the profit for the year, that needs to be transferred at the end of the year onto the SFP or whenever the reporting period is. So you can see that builds up in retained earnings. So the profit from the P&L ends up in retained earnings. The profits and gains which go through OCI end up in their own separate reserve in equity. But the mechanics are the same. These are income statements. The profits are transferred into equity because a gain is an increase in assets. So the assets have gone up, and this is represented in equity here. So you can see what would happen. All of the benefit of the revaluation, the fact that the asset has gone up, ends up in a revaluation reserve because the increase went through OCI, ends up in a revaluation reserve. The P&L suffered because of the higher depreciation. So therefore, retained earnings end up lower because of the revaluation than they would have. So therefore, the consequence of that is, of course, dividends are paid from retained earnings. So when the profits of the company are paid out to shareholders, they're paid out from retained earnings. When you think about distributable profits, what can be paid out as a dividend is predominantly, just retained earnings. So what we can see is that retained earnings will now be lower, and therefore dividends could potentially be lower as a result of the revaluation. The revaluation reserve, will be higher, but dividends can't be paid out from here. It's an undistributable reserve. Therefore, what we can do is transfer the excess depreciation from the revaluation reserve to retained earnings. Now, we said the P&L is going to be lower because of the additional depreciation, and the building would always be depreciated, but the fact it's been revalued now means depreciation will be slightly higher. So depreciation is slightly higher. That reduces profit by that additional bit of depreciation. So depreciation a bit higher reduces profit by that additional depreciation, and retained earnings is now lower because of that additional depreciation. So what we can do is we can put retained earnings back into the position they would have been without the revaluation by transferring that additional bit of depreciation from the revaluation reserve to retained earnings. So we're basically putting retained earnings back in the position it would have been had it not been for the revaluation. And that's an accounting policy choice. So the company doesn't have to do that, but we can see here that they've decided, that they do want to do that. So of course it's, additional work to do it and to calculate it. So if there aren't issues about dividends not being able to be paid, then perhaps a company wouldn't spend the time doing it, but it's probably best practice to do so. So that's what that point is there. So they're the issues really around using the revaluation model. So let's bring this to life now with some numbers, and again we'll continue to think about the exam technique that we'll use here. So once again, you can kind of see how, we've been through this question, we're thinking about all those complicated parts about the annual transfers between the revaluation reserve, and you might have all these things racing through your mind of, how does the transfer work? Does it impact the P&L? Does the depreciation in the P&L get impacted? And you're thinking about all of this, and you're kind of perhaps panicking a bit on exam day, but just try to keep calm. Start with the basics first of all, the relevant parts of the relevant standard, then apply it to the scenario, then do the numbers, and that's when you're going to get onto that hard bit. But if you've kind of got the other bits up until that point, then you'd have done really well. And even if you make a small mistake with the numbers, then you should still be able to pick up, full marks. And the other thing I like about this approach as well is that not only does it mean you pick up lots of easy marks along the way, but it kind of eases you into the question. You have to kind of think, okay, what's the relevant part of the relevant standard here? And then once you've kind of thought about that, you kind of think, okay, well, they're the relevant rules. And once you've identified the relevant rules, then when you apply it to the scenario, it's quite a bit easier because you've identified the relevant rules, and then all you're doing is applying them. And then the numbers is just kind of applying that, to the actual figures, and then you should overlay the numbers onto the financial statement. So I think it's good to do this. One, because it should get you a mark, but two, it kind of sets you up nicely for your answer. So if we think about, the relevant part of the relevant standard here, obviously in all of these questions, we're going to be looking at IAS 16 because we're looking at assets and specifically PPE. We can say under IAS 16, accounting policy choice as to whether to use cost model or fair value or revaluation model. So that's an accounting policy choice. And you could just briefly mention your assets of same class must follow same model. I mean, that's probably going to be more relevant where they tell you that the company follows the cost model, but they've got one particular building that they want to revalue because it's gone up in value. So that point would be more relevant there, but it's still valid to make here. We could make the point that they should be revaluing all land and buildings, but that doesn't seem to be the main part here of the question. So we could say, under reval model, increase in value recorded through OCI. Now, if there's a decrease in value, then that's effectively an impairment. So we account for that in the same way as an impairment, but we'll look at that when we look at impairments later on. So, and of course, we're looking at an increase in value here. So you can see what I mean about keeping your points very specific to the scenario. It's gone up in value. There's no point talking about a decrease in value here. And that part of the standard isn't really relevant to this question because it's gone up in value. So why spend time, talking about, if it's gone down in value, then credit the asset and debit, to the OCI up to the amount of previous gains and then the excess, in the P&L. That isn't relevant here. So that's what I mean by relevant parts of the relevant standard. Keep it very focused on the bits which are, really relevant to this specific question. And then we could mention a point as well, additional depreciation arising from increase in carrying amount can be transferred from revaluation reserve to retained earnings. So they're kind of the relevant parts of the relevant standard. As I said, 2 to 3 points, would be sufficient. Focus on the main ones which are most relevant, and then we can apply it to the scenario. So, they want to use a revaluation model. So you could say, it's always good to briefly mention the company name. I guess that keeps it quite relevant as well. So rather than saying the company, we could say H Limited can use a revaluation model provided all other freehold land and buildings follow the same model. So we can see here that revaluation model for all other freehold land and buildings, provided that they follow the same model. So we can see here that that all looks fine. We're not told anything more about that. So we've said the increase would be recorded through the OCI. We've said depreciation can be transferred from the retained earnings. We probably don't need to add on too much more. It's mainly here going to be about the numbers, so there isn't too much more we can apply here. We've said that they can follow the revaluation model. We've said what the revaluation model involves. There's probably no benefit in explaining that again. We don't really need to apply that anymore. So we can think about how this would look on the numbers. So if we think about what our PPE looked like previously, we've got the lands and buildings and the total. Now we're told here what they originally cost. So the land was 425k, the buildings were 150k, and then we got to the total. So therefore we've got the original cost. Now we know, so that's the original cost of the land and buildings. So we've got the cost there. Then we'd have the depreciation for the first year to get us down to our carrying amounts, because we need to know what the carrying amount is at the date of the revaluation. So we're at this date, this is when the assets are being revalued to at the start of the year. So the land and buildings the buildings were being depreciated over 50 years. So you've got the buildings being depreciated over the 50 years. And there we've got the land here. So therefore we can see the carrying amount for the land and buildings. So that's what they would have looked like at the end of the first year. So initially the cost would have been capitalized on the SFP. So as we've said, we had the cost of the land and buildings. Then there would have been that depreciation of 3k in the first year, which would then get us down to our carrying amount at the year end of 572. So we know what the carrying amount is at the start of the year. And then we would have our uplift to fair value. And we can see that the land has now gone up to, so we were told in the question, land is 550 and buildings 170, just by working out the difference. So you can see how much they've gone up to. So therefore you can see the increase in valuation. So it's a 145 increase above the cost. And of course that buildings have been depreciated as well. So if we can see how much each asset has gone up by, of course we'd need to know it for each amount in terms of the new fair value, because we'd have to depreciate the buildings, but not the land. Therefore the PPE has gone up in value of this. On the SFP, this is the value of the PPE, but it's now gone up to this. So we did have to show the journal entries for these workings. We could perhaps kind of show them to the side each time. We could show them above, but the entry here would be to debit PPE. So we'd have a debit to PPE of the 148k, and we'd have credit to OCI. So when we say kind of debit PPE, the way it would work, if we think about like our PPE note quickly, so the PPE note, which is a note to the financial statement. So after the P&L, so in our financial statements, you'd have your main statements, the P&L, the SFP, cash flow statement, but then you'd maybe have a note here. So it'd say in brackets, note 1, and then you'd go to note 1, or it'd probably be a later note, probably be more like 4 or 5. You'd go to a later note in the financial statements, and you'll have a PPE note, which kind of just shows you more detail on the PPE amounts and how they're kind of broken down. So in the first year, if we look at this single asset, in the first year, you'd have the addition in the year, because that's the year it was acquired. So you'd have the addition for the asset, and we know it was purchased for 575. So in the first year, we'd have the addition of this. There'd be the first year's depreciation of 3, and therefore you'd get to your carrying amount carried forward, for this asset. You'd obviously have it for all of the assets. This is one note for all of the assets, but if you think about this specific asset, we'd have the addition of the 575, because that's the year it was purchased. So this is thinking back to X1, depreciation for the current year, and then we'd have the carried forward amount for that asset. So then in the following year, those amounts are the brought forward amounts. You'd have the brought forward cost amount of the 575, brought forward accumulated depreciation, and then the brought forward carrying amount. So you can kind of see it just splits it out between cost and depreciation. So therefore, technically, the way this works, this debit to PPE, it reverses that depreciation, first of all, any depreciation on the asset, and then increases the cost amount. So you kind of think about this debit to PPE kind of being split into two. We debit the accumulated depreciation, first of all, for any amount of that. So we've got the 3k of accumulated depreciation. So that's effectively kind of gets reversed here. So you'd have 3k here to reverse that brought forward accumulated depreciation, and then the rest would go to the cost amount. So you'd have 145k go into the cost amount, because you said you start with the brought forward cost here for the land and buildings, and therefore the 145 would go to that. So you can see we'd have the cost amount there. So just to kind of demonstrate how that is split out between the two, and therefore you'd have your kind of cost amount, which would now be at the fair value. So you'd have your cost brought forward, and then your revaluation. So that's where the debit goes once the accumulated depreciation on the asset has been reversed. And we'll see more of the PP note when we look at single entity financial statements, which is typically a question 1, because this usually follows on from having to prepare the financial statements. We can kind of do this at the same time to get to our carried forward figures. So I've got a few nice shortcut methods there where you can kind of do this at the same time as doing the SFP for question 1, but we'll cover that in a later class. But worth just having to think about the PP note now whilst we're looking at PPE. So those would be the entries, but that would be sufficient for an explaining question, because you're clearly showing where the entries would go. But if you wanted to, you could show this as well. So we said this gets recorded through OCI. So we can see we've increased our asset in value. So if we think about our SFP, we're increasing that asset in value. So it'd now be up to its fair value. So that's gone up in value. And we've said this would be recorded through other comprehensive income. So we're going to have 148k here in other comprehensive income. Our PP was at this amount because it was its cost minus the depreciation from the first year. So we had our PP carrying amount at 572. We've now increased it up to its fair value, up to the 720, and that gets recorded through other comprehensive income. So therefore, you could start off with that bit, first of all. I think, it wasn't too difficult to, work that out. We've got the journal entries as a requirement asked for. I think that was all fine, actually working out the uplift in its fair value. So you can think what happens. Now, the valuation was done at the start of the year, and we're preparing the financial statements for the year ended 31st of December X2. So therefore, there'll be a year of depreciation, and then we can get down to the carrying amount. So if you think about this building had a 50-year useful life. It's now got 49 years left, and therefore we're going to have some additional depreciation on the building. So we've got the fair value of the building, what its worth is now. It's got 49 years left. Usually it tells us that the useful life hasn't changed, but unless they tell us it has changed, then we'll assume that it hasn't. So therefore it needs to be depreciated over 49 more years. Land, of course, isn't depreciated, and therefore we can get down to the carrying amount. So we get to the carrying amount of the land and the buildings. So we've got the value of the buildings here, which were fair value minus the depreciation. So just kind of sense check those. So it's got its higher value now for the building, minus that depreciation based on its fair value amount. And then the land, we now have that at its fair value. And therefore you can see that we'd have the land and buildings, which would be recorded at this amount. And you could always just sense check your answer as well. We've increased it up to fair value minus that additional depreciation. That gets us to our carrying amount. And does this all make sense? Buildings with this cost have been depreciated by a year, uplift to fair value. That's the increase. We've got that bit of additional depreciation. So therefore that would be the carrying amount at the year end. And we've got the land there as well. So therefore we've got it up to its fair value here. We've got that depreciation, which of course you can see is now going to be higher. So you can kind of see the issue that we've got. And then we get to our carrying amount at the year end. So we could show our depreciation charge for the year. That would obviously be credit PPE, debit P&L. So we're going to have our depreciation charge for the year. So then what we're going to need to do is we're going to need to think about this transfer. So you could, even if you wanted to, start putting these numbers on to your draft profit as you go, or you might just want to do it all at the end of the note. So we've said, of course, that gain was recorded through OCI, but now in the P&L, we're going to have some additional depreciation. So what would happen, at the end of the year, this would all get transferred. So what's in the OCI gets transferred into the revaluation reserve. And what we'd have in the P&L ends up in retained earnings. So this additional depreciation, so if the asset had never been revalued, we would have had depreciation of 3K. Instead, we've got 3,469. So therefore, there's like an additional depreciation of 469. And therefore, that's reducing the profits for the year. So you can see profits for the year are now going to be lower, and profits are transferred into retained earnings. So therefore, retained earnings are going to be lower. So you can think of retained earnings as now being lower by that amount. So what we're allowed to do is, because revaluation reserve has had all the benefit from the revaluation, and retained earnings has suffered because of that additional depreciation, we can put retained earnings back into the position it would have been had it not been for the revaluation. So if we're going to increase retained earnings, and of course we're going to credit retained earnings, to reduce the revaluation reserve, debit revaluation reserve, because they're both equity amounts. To increase an equity amount, you would credit it, and to reduce it, you would debit it. So we can see the additional depreciation, quite easy to see there because we've done the PPE working. So what it was based on historic cost and what it is now going forward. And therefore we can do that transfer, and what that transfer would do is it would put retained earnings back in a position. If you think, retained earnings are 469 lower, if you transfer 469 into them, they're back in the position they would have been. The revaluation reserve, of course, would end up being slightly lower by that transfer. And you can do that transfer every year. So every year it puts retained earnings back in a position that it would have been. So hopefully that's kind of quite clear why we would do that there. So again, we could copy our workings over. We probably didn't really necessarily need to do the carrying amount for the year end, but as I said, it's always useful to do it with assets. You probably get a mark for saying what the carrying amount would be at the year end. So we can copy that over, and then we could probably just add on a few kind of applying points here and just kind of explain what we've done. So we said they could all follow the same model. So you could have it here, or we could have it below. So we could say, revaluation gain recorded through OCI, because we've set the journals out there, so that's fine. So you can say additional depreciation in P&L as a result, and this impacts retained earnings. So you say, therefore, can transfer excess additional depreciation from revaluation reserve to retained earnings to put retained earnings back in position would have been without the revaluation. And therefore that's kind of, quite clear what we've done. We've got the journal entries, we put them there this time rather than kind of typing them in separately in a narrative, but we've got the revaluation itself, that was historic depreciation. So that was recorded last year, that depreciation. So this year we've got the revaluation, we've got the new depreciation charge, and therefore we've got that transfer as well. And we've kind of just shown how that would be split between the two. That might not be necessary in this question, but it was good to put that in. So then, as we did with the previous question, we can think about what impact this would have. So if we take it one at a time, obviously, the first thing that happens is there's the revaluation. So that increases PPE, but the credit goes through OCI. So therefore, assets have gone up, but the credit's gone through other comprehensive income. So therefore, that isn't going to impact because we're just showing profit for the year, and that's profit in the P&L. So we're not going to show that anywhere. They haven't asked us to show the OCI. So then we've got the additional depreciation, which reduces the PPE because we're depreciating the asset. And of course, it also reduces profit. And then the final adjustments was that reserves transfer, that equity transfer between retained earnings and revaluation reserve. And if we're just preparing profit and assets, that isn't going to have an impact there. So you can see that we've got a different, note here. We're looking at, subsequent measurement under the revaluation model, but you can see that the exam technique, is the same. Relevant parts of the relevant standard. Yes, they've got this accounting policy choice, so they can follow either, provided that all assets of the same class follow the same model. Under the revaluation reserve, increases in value recorded through OCI. That can result in additional depreciation, and therefore there can be the transfer. It wouldn't be worth mentioning this if the question said they do not wish to make the transfer. So they can use a revaluation model provided freehold land and buildings. So you can see how we're just kind of applying this point, here, because we're saying assets of same class. That's kind of a bit abstract, a bit vague, but then we're applying it to freehold land and buildings. So then we can go through, and calculate the numbers. We can work out what the revaluation would be. We can work out what the depreciation would be and therefore what that transfer would be. And then we just kind of got a few points here applying it to the scenario. When we said before, you could say, what they've done wrong, but it sounds as though we're not told kind of what they've done or, why what they've done, might be wrong here. So there wasn't really anything to say there. You could briefly say what the carrying amount is at the year end, but we've kind of got that there. So hopefully we kind of get credit just for having it there. Obviously quite a time pressured exam, so we don't want to spend too long typing out points. We've already kind of got the marks. We've already said it before. So far, we've looked at when a company first acquires an asset, and we think about, can they recognize an asset on the SFP? What costs can be included when they first recognize that asset? And then going forward, how is that asset measured? Cost model or revaluation model? Now, later on in the asset's life, it could be the case that the asset becomes impaired, so that its value is lower than what's recorded in the accounts, so we reduce the value of the asset. So we do this impairment test and we consider whether the asset is impaired if there's an indicator of impairment. So if there's physical damage, if there's a fall in the fair value, if there's a change in the market that the asset is used for. So if it's a piece of machinery and it's used to make a certain product or service, and there's a change in the market, so there's going to be less demand for that product or service. So it'd be an impairment expense if its carrying amount is higher than what we call its recoverable amount. And the recoverable amount is simply what the company would get for using it. So if you think the company owns an asset, a piece of plant, a building, a piece of equipment, a motor vehicle, to generate cash from it, to get future economic benefits from that asset, there's more or less two things they can do with it. They could either sell it, you could sell it and get money for it, get cash from it by selling it. So it's fair value minus any costs to actually sell it. So kind of like the net proceeds, if you like. Or they could use it. You could use it to make goods and services and sell those goods and services. So if you own an asset, to get money for it, you can either sell it or use it to generate money to produce goods and services. So therefore we say the recoverable amount, what the company will actually get from the asset, is the higher of the two, because we're basically just assuming that they'd use the higher of the two. If you've got an asset and you could either sell it for 10,000, or you could use it to generate cash flows of 4,000, presumably you'd sell it because you'd take the higher of the two. So you could think about it like that. That's why we take the higher of the two, because that's almost like the common sense decision. That's what the company's going to get from using it, because presumably they'll use the higher of the two. So if what they're going to get for using that asset or by selling it is less than what it's worth on the SFP, then that means that the amount on the SFP, the amount we've got recorded here in our asset, is too high. That isn't what the asset's worth. That's overstated. So therefore, we'd reduce it down to its recoverable amount, and that's why it's impaired. You'd have to reduce the value of the asset. So this is quite similar to if you were following the revaluation model and you had a downwards revaluation. So if we had this item of PP that we'd uplifted previously, and then we did the revaluation the following year and it had fallen in value, clearly its fair value has fallen. So therefore, under the revaluation model, you'd reduce the value of the assets. A reduction in value under the revaluation model is kind of quite similar to an impairment, because we're reducing the value of the asset. So therefore, we're going to have to do this impairment test when there's an indicator of impairment. So we can see here that on the 31st of October X2, and machines, so still looking at PPE, we've got 31st of October X2, so 2 months before the year end, was identified as requiring maintenance work. So perhaps that's an indicator of impairment. The machine originally cost 60K, on the 1st of Jan X 0, so 3 years before the end of the year we're looking at, and had an estimated useful life of 8 years. We know how long it's been depreciated over. So they haven't told us the carrying amount, they've told us the original cost, and we know the useful life. So therefore we could work out what the carrying amount is, at this date. Depreciation on a straight line basis. An impairment review was carried out. So we could have perhaps suggested an impairment review needs to be carried out, if the asset is damaged. They've told us an impairment review was carried out at the year end, and the machine was assessed as working at an acceptable level with a revised useful life of 5 years. It's got 5 years left. On that date, the machine's fair value, so what they could sell it for, was assessed at being 10,500, selling costs of 500, and its value in use of 11,000. So they've got this machine. If they sold it, they'd get 10,000 for it. They'd sell it for 10.5, but they'd have selling costs of 500, so they'd be left with 10,000. So that would be the fair value minus cost to sell, or they could use it and they'd get 11,000 for it. So the way we'd account this for this 11,000 is we would look at the cash flows that's going to be generated from it and discount them down to their present value. So therefore we'd have to start with what the cash flows were and discount them down to their present value. So to give you a straightforward example of this, maybe it was going to be 1,000, 2,000, and then 4,000, maybe 8,000, something like that. So you have the cash flows each year, but this is at year 1, year 2, year 3. So because those cash flows are in the future, we need to discount them down to their present value. So the reason we need to discount them down to their present value is because £2,000 in a year's time isn't worth the same as 2,000 today. Because money in the future is worth less because of inflation. So 2,000 today would buy more than 2,000 in a year's time. There's also foregone interest and risk as well. 2,000 in the future is more uncertain than 2,000 today. So if they tell us to use a 10% discount rate, the way you could do this in the FAR exam would be to 1 divided by 1 point, and then if we're using 10%, 0.10 to the power of how many years. So therefore you could have the years there and drag that down. If you had a constant cash flow, you could use the present value function in the exam. But clearly they've kind of done this calculation and they've got down to exactly 11,000. So that's what it means by value in use. Looking at those future cash flows, but they have to be discounted to present value. So we'll see much more of this when we look at other topics, when we look at revenue, provisions, leases, financial instruments. We'll see a lot more of this discounting to present value. But whenever you have a cash flow in the future, a year or more away, you need to discount it down to present value. So what we're saying here is 2,000 in a year's time is worth this today. Because if you had this today, if you had 1818 today, then you could earn interest effectively at 10%, and therefore you could see that in a year's time, you'd have 2,000. So therefore, if this is in a year's time, this is today, then you can clearly see that in today's terms, that's what 2,000 in a year is worth. It's like the reverse of interest. Discounting is like the reverse of compound interest. So if this today is worth 2,000 in a year's time, then clearly 2,000 in a year's time is worth this today. So therefore, we're just kind of like discounting it back to its present value, as I said, the reverse of interest. But in the FAR exam, any amount which is going to be paid or received in more than a year's time needs to be discounted to its present value. So there are some exceptions in the real world and in some other standards such as tax, but for the purposes of the FAR exam, you always discount any future payments down to their present value. So really important that you are comfortable doing that. So therefore we can see with this asset, we can see that we know its value in use and we know its fair value, so what they'd get from selling it. And clearly we can see its value in use is higher, so we'll assume that's what they'll do. They'll use the asset to produce these cash flows because that's better than just selling it. So what we need to do first of all is work out the carrying amount, because we know what its recoverable amount is, but we don't actually know what the carrying amount is. It would have been nice if they just told us, the carrying amount at this date was, 15,000, and therefore we could just work out, the impairment of 4,000. But they haven't told us that, so we've had to kind of work a bit here to get ourselves down to the carrying amount. So we're going to have to do that as part of our answer. But again, let's not kind of rush into it. So you might be thinking, how am I going to work that out? Do I need to do a residual value? I can't see anything there. So again, don't kind of get too drawn into the complicated parts straight away. Start with the relevant parts of the standard. So, under IAS 36, so a different standard here for impairments. So under IAS 36, we could say asset must be tested for impairment if impairment indicator, or if there is an indicator of impairment, asset impaired if recoverable amount is below carrying amount, and you could put recoverable amount is higher of fair value minus cost to sell and value in use. So then we could apply it to the scenario. So we could say, as plant, or was it machine, as machine needs maintenance work, then indicator of impairment. And they have actually done the impairment test, so it will, they've done the impairment test, so therefore they haven't done anything wrong, so the impairment review was carried out. So what we need to do now is look at the carrying amount and compare that to the recoverable amount. So we know what the original cost was, that was 60k, so therefore we have our depreciation. Now we're going to have depreciation to get to the carrying amount. We're going to have the depreciation for 3 years. So we're going to have depreciation for 3 years. So if we work out what the depreciation is per year, so it's told us 8-year useful economic life, 8-year useful economic life, and no residual value. We're not told about a residual value. So therefore we can see what depreciation would be each year. We'd have 3 years for that, and therefore we'd have the carrying amount at the year end. So actually they were quite nice with the dates in that they bought it here, and then we're doing the impairment review at the year end. We didn't have to prorate the depreciation in any way. So therefore we've got the carrying amount of the asset, and we just need to compare it to its recoverable amount. So this is what is on the SFP at the moment, because they purchased the asset, they've depreciated it. We're not told it's previously been written down, impaired or revalued or anything like that. So they must have just purchased it, depreciated it. We've got it at its carrying amount. And then we just need the recoverable amount, which we said is the higher of fair value minus cost to sell. So you could just show these here. So the fair value minus cost to sell is obviously the 10k, value in use. You could put just that here, minus cost to sell. Value in use, as we said, is 11k. So we didn't have to work out the value in use here. In other questions, you could. They could give you the cash flow. You've got the discount factors, and you get down to the present value. As I said, if you had a constant cash flow, you could use a present value function in the software, but probably not necessary for the FAR exam. And cash flow forecasts are only over 5 years anyway, so it isn't difficult to do a discount factor for the 5 years as well, especially if you're going to use a formula like this. You've got a number of years there. So then we've got the recoverable amount. So we'd obviously take the higher of the two. We'd assume that's what they're going to use the asset for to generate those cash flows. And therefore you can see if we're going to reduce the asset in value by this is what the impairment is. So therefore we've got the impairment. So you can see that you've got, your asset at the moment is at the 37.5k. we're going to reduce that asset down. So clearly we're crediting PPE to reduce the value of the asset. So we're going to have credit PPE. Again, we could do our journals here and copy them over, or you could type them out separately. So we're going to have credit PPE and debit. Now this is all going to go to the P&L, but if that asset had been under the revaluation model and had previously been revalued upwards, then you would firstly debit OCI up to the amount in the revaluation reserve for that asset. So if you think about our previous asset that had been revalued upwards, if that asset was impaired, then the impairment would firstly go through OCI rather than the P&L up to the amount that's in the revaluation reserve. But we're not told anything about this asset previously being revalued upwards and there being an amount in the revaluation reserve for that asset. So therefore it would all go to the P&L. So just a point there to be aware of. It wasn't relevant to this question and therefore we're not going to mention it in our answer, but just something to be aware of, that if the asset had previously been revalued upwards, then the impairment would go through OCI to the extent there's an amount still in the revaluation reserve for that asset. So we said machine needs maintenance work, then that's an indicator of impairment. And we could say it here. So we could say, recoverable amount is 11K because higher than fair value minus cost to sell. Asset is impaired by 26.5K. This is recorded in P&L, and you could just put, as asset has not been revalued previously, and therefore there's not amount in the revaluation reserve for this asset. So we don't have to worry about depreciating this asset because this was done at the year end. So they've kind of depreciated it in the year. They've done the impairment test here. Going forward though, we were told it's got 5 years left, which I think means it was consistent with its initial expectation because there was 8 years. We're now 3 years into it and there's 5 years left. So that would be the depreciation going forward. We didn't have to do this year because we're at the end of the year in this impairment test. Next year, that would be the impact. So you can see, short, concise range of points, a relevant part of, the relevant standard, maybe a couple of points there. Apply it to the scenario, kind of said what the recoverable amount is, the asset's impaired. You could have had that bit, above here if you wanted, and then the numbers, further down, it wouldn't matter. But we've got those there. We've got the journal entries as was required by the question. They already would have recorded that depreciation. There's no mention that they hadn't recorded the depreciation. And there wasn't really anything they'd kind of done wrong. We're just kind of telling them how to deal with the impairment. They've done the impairment review. They've got the numbers, but perhaps they hadn't actually just done the actual impairment bit. They left that for us to do. So then once again, so for note 3 this time, we've got the impairment, which obviously is all going to the P&L. So that reduces the profit. And of course, that reduces the asset. To get that asset down to its new value, we're going to record it at its recoverable amount there in PPE. So not too difficult to deal with that. You can start to see once you get the exam technique, once you start to build up a bit of a role, you start to kind of get into it, you get really used to this exam technique. So it's really important that you then just go away and practice several questions, one after the other. We'll talk about that at the end. So note 4 told us that 2 months before the year end, company made the decision to close a smaller manufacturing operation in Warrington and move to a single central location in Manchester. So on this date, 2 months before the year end, the property was offered for sale at its fair value and advertised in the relevant trade press. The company's commercial property agent has advised that properties in Warrington are generally selling within 8 months. Although there has been some interest, it remained unsold at the year end. Information for the property is in the table below. So we've got this property which originally cost this. Now its carrying amount is higher than its original cost. So that's kind of telling us it must have been revalued. So we've got this carried amount on the SFP. So on our SFP, we've got this property of 360k. That was its original cost. Now we're told in the revaluation reserve, there's 82,500. So there must have been some revaluations in the previous year. So, it must have gone up in value in previous years, and this is built up. So the asset is increasing in value. That's gone through OCI and accumulated in here. There might have been some transfer to retained earnings, there might not. So the asset's gone up in value, and then the asset, continued to be depreciated. We don't know exactly when it was revalued, whether they've done the transfer between reserves. We just know the amounts at this date. So we see that's what's happened with the asset. Now we're being told they've made a decision to close it, so to close a smaller manufacturing operation and move to a single location. So we're told there's a property. So the asset we're looking at here is a property. So it's part of a decision to close, an operation, perhaps in a certain geographical area. We don't know. We'll come back and think about this. But what we're told here is that the freehold property is going to be sold. So that's the asset that we're looking at. We're told information about the property here. So it's going to be sold. So it hasn't been sold yet, so we haven't disposed of an asset. But you can see we're getting further through the asset's life. We thought first of all, buy an asset. What do you recognize as an asset? How do you account for it going forward? Perhaps it becomes damaged and impaired at some point. And now we're starting to think about, what happens when they decide to get rid of an asset, dispose of an asset. So we can see here that we're told they're going to sell the asset. So it's been offered for sale at its fair value and it's been advertised. But what we are told is that it's unsold at the year end. So they haven't sold the asset. They still control the asset. They still meet the definition of an asset. It's still controlled, past events. They're still going to get future economic benefits from it because they're going to sell it. It's an asset which is now what we call held for sale. Now, if certain quite strict conditions are met, then that asset can be taken out of PPE and presented as assets held for sale. So it's reclassified. So it's classified somewhere else on the SFP. So we take it out of PPE and record it as assets held for sale, but only if these strict conditions are met. So if the asset's available for sale in its present condition, so it doesn't require additional work to be sold, sales highly probable within 12 months. This is quite vague as to what constitutes highly probable. We know from provisions that probable means more likely than not, more than 50%. There isn't really a kind of a clear definition of highly probable, but presumably more than that, maybe 70. Management are committed to selling the asset. It's been advertised at a reasonable price, and it's unlikely that the plan will change. Now, the open book, so the IFRS book, is quite useful here. I think it's only really useful in the exam if you're limited circumstances, because when you're using the open book, obviously you're spending time looking something up, and that's time which could be spent typing a mark scoring point. So therefore, in a way, it's a bit of a trap, or certainly at least a bit of a compromise by looking things up in the open book. So I use it as little as possible. In fact, I don't really use it at all. There's probably a couple of areas where I do think it is quite useful, and that's where there's some very strict conditions for a certain treatment to apply, and therefore IFRS 5 assets held for sale and discontinued operations as well perhaps is useful, because remembering all of these conditions might be quite tricky, and it could be useful to just kind of look them up and check them in the exams. You can go through and see whether the company's met them. Other areas where it's quite useful, and it tends to really be around assets, but intangible assets, when we think about whether you can capitalize research and development costs, that's quite useful as well, because there's 5 strict conditions there. And maybe borrowing costs as well, because there's rules there about when the capitalization starts and when it ceases. So you might find that useful. And that's really where I find it useful. Possibly if you struggle to remember the layout of the cash flow statement, there's investing come before financing, or, the other way around. So it could be useful there. There are other areas which obviously are useful, but I think it's best to be at a point where you've understood the technical content, where you're only looking up 1 or 2 areas. And I think this is particularly difficult to memorize, or there's just kind of quite a lot to memorize. So therefore, if you have that in your open book, then that could be one of the few areas you do decide to look up in the exam. But you can see, most of the marks are for applying the content anyway, so it isn't hugely critical that you kind of get every single kind of point of the standard. It's only going to be where you need certain conditions, which are going to then determine your subsequent treatment. So therefore, that's why, again, it's probably quite valuable, perhaps, to look these areas up. So if they do meet these strict conditions, now if they don't meet these strict conditions, it just continues to be treated as PPE, normal cost model or revaluation model, and it's still PPE. But if they do meet these conditions, then what happens is, firstly, assets which are measured under the fair value model are remeasured to fair value and then classified as assets held for sale. Now, if they don't use the fair value model for the assets, if they're not using a revaluation model, then you don't need to do this step. So if we're not using uplifting assets to fair value, then we don't need to do this step. So whether we're using a revaluation model or whether we're using the cost model, there'll be an impairment expense if the fair value minus cost to sell are less than the carrying amount. Now this, might ring a bell because you can see we've kind of done a similar test to this when we've done an impairment test. We compared here the carrying amount with the recoverable amount, and that was fair value minus cost to sell or value in use. So the key difference here, there's no mention of value in use. Well, that's because if you're selling an asset, then it's not going to have value in use because you're not going to use it. Remember, value in use is the cash flows that are going to be generated from the asset. But if you're selling the asset, you're not going to be using it to generate cash flow. So the only way you're going to get money from an asset, which is being held for sale, which you're going to sell, is, of course, by selling it. So it's just like an impairment test. It's just there's no value in use figure because you're not going to use it. The only way you're going to generate cash from it is by selling it. So it's just like an impairment test, but without this. So you kind of think about it like that. And of course, there'll be an impairment expense if its fair value is less than its carrying amount. And then the asset is no longer depreciated. So again, it's one of those where you might be thinking, oh, it's fair value model clearly because they've been uplifting it to fair value under the revaluation model. So therefore, we're going to have to remeasure it to fair value. And how do I do this? What impact would any impairment have on the revaluation surplus, et cetera, et cetera. But again, just start with the basics first of all. Under IFRS 5, assets can be presented, reclassified, classified as assets held for sale if strict conditions met. So you could kind of list out some of the conditions here, or maybe when we do our applying bit, because we usually say the relevant parts of the standard and then we apply it to the scenario, maybe we'll kind of go through them then and apply them to the scenario. Otherwise, you're going to list out the conditions and then have to apply them, or you're going to have kind of a lot of typing to do. So we might be able to be a bit more efficient there. So we could say asset remeasured to fair value minus cost to sell if lower than carrying amount. And we could say, for assets under revaluation model, asset remeasured to fair value prior to reclassification. And you could maybe mention your assets held for sale, no longer depreciated. So you've kind of just thought, what's the treatment here? Well, I know that there's these strict conditions, and if they're met, it'll be an asset held for sale. And then when it's an asset held for sale, it's remeasured to fair value minus cost of sale if that's lower than a carrying amount. We could put remeasured to, lower of, or measured at, asset measured at lower of fair value minus cost of sale and carrying amount. So for assets under the revaluation model, the assets remeasured prior to classification. So that's relevant here. If this was an asset and they told you it's under the cost model, I wouldn't mention that point. There'd be no need to mention that point. And the asset held for sale is, no longer depreciated. So now we can apply it to the scenario and we can think, do they meet these conditions? That's why it might be useful to have the conditions. So is it available for sale in its present condition? We're not told anything about that. It sounds as though they're kind of using it, it's been advertised that it's fair value. There's nothing to say that it isn't. So you could just put, asset, appears to be available for sale in present condition. You could just put here, need to confirm, because I haven't explicitly confirmed that point there in the scenario. Sale highly probable within 12 months. So we were told the property agent has advised that properties in this area are selling within 8 months. So therefore, it does appear as though it is highly probable it will be sold within 12 months. So you could say highly probable will be sold in 12 months as properties selling within 8 months. Therefore, that certainly appears highly probable. Management are committed to the sale. So are the directors committed to selling the asset? Well, they made the decision. So it's the directors who make the decisions for the company. So the decision's been made and they're advertising it. Management are committed because decision has been made and, property advertised. That's actually kind of one of the conditions as well, that it's being advertised. So is it being advertised at a reasonable price? So we're told it's being offered for sale at its fair value. So its fair value is what someone would pay for it in an open market. So, the best way to get the fair value would be to get an identical property and look at its fair value. So, the property, next door or similar properties in the area, perhaps. Property advertised at reasonable price because advertised at fair value. That's like its open market price. Therefore, that all appears to be met. Is it unlikely that the plan will change? And we're not told about anything that suggests it's going to change. So you could say need to confirm, but nothing to suggest that plan will change. So there are a few bits that weren't quite 100% clear on, but it does appear as though they meet the conditions. So you could say, therefore appears to meet, or we could just say, appears, because some bits are so not uncertain, but perhaps some of the more kind of less specific areas just need to confirm. Therefore appears to meet asset held for sale criteria. So as we've said, because it's under the revaluation model, it's remeasured to fair value prior to reclassification. So I've mentioned those points there. So you could mention, again, needs to be, remeasured to fair value, but we've kind of got a lot of the points here. So you're going to remeasure it to fair value first of all. So if you think about this asset, and again, if you think about, the numbers, I know this is going to be tricky, but you've kind of got all of these marks on the way. And we've not only have we picked up marks, we've kind of set ourselves up. We've kind of thought, okay, well, what do we need to do when an asset's reclassified as assets held for sale? Well, we firstly need to remeasure it to fair value. So we've got the cost, we've got the depreciation, but where we are now is we know the carrying amount, and we know the carrying amount at the date it's reclassified. So we've got all the information at this date. So we've got its carrying amount of 360k. Now it's remeasured to its fair value, just as we did previously. This is just a point where you remeasure it to its fair value. So we're going to remeasure it to its fair value. They probably would have been doing this every year anyway, but maybe they did it at the year end, and now we're like partway through the year when they're reclassifying it. So you do that revaluation now. So you can see its fair value is 165. Now we're told the selling costs. Now, when you're remeasuring an asset up to its, fair value under, like the revaluation model, you're not taking into account the cost to sell. So when you're doing a revaluation, it's just, the carrying amount versus the fair value. It's when you're doing an impairment, it's fair value minus cost to sell, or asset held for sale minus cost to sell. Very difficult, point there to remember. You only take the cost to sell in, when you're actually looking at an impairment or an asset held for sale, not in like a regular revaluation. So we can see here that we'd have the fair value, which is considerably lower, and therefore the asset has fallen in value. So on the SFP, the asset would be reduced down to its fair value. So that's a substantial decrease in its fair value of 195k. Now this is very similar to what we've seen before, a downwards revaluation effectively. So if you're under the revaluation model and you did your revaluation every year and the fair value is now lower than the carrying amount, so maybe our first or second example we looked at where we said we measure it under the revaluation model and it had gone up and therefore we credited OCI and debited PPE. Of course, that could go the other way around. The asset could fall in value and therefore when you do your revaluation under the revaluation model, it could have gone down in value. We've of course seen something similar with an impairment where we said its carrying amount again is higher than its recoverable amount, and we could have used the fair value there if value induced was lower. And again, we see the same thing here with an asset held for sale. So you can see the same thing is kind of happening, and the accounting treatment is very similar. Every time we're going to have to reduce the value of the PPE, and that's what we've done here. So we've reduced the value of the PPE. So we've got a debit, we know we're going to have like an expense because an asset's fallen in value. The question is, where does it go? Well, as I said before, whether you're looking at a downwards revaluation or whether you're looking at an impairment or whether you're looking at an asset held for sale, PPE has gone down in value, you're going to have an expense. Now, if that asset has previously been revalued upwards so that you have an amount sitting in the revaluation reserve for this asset, then the impairment will firstly go through other comprehensive income to eliminate that revaluation reserve. So you can kind of wipe this out first, so it can go through OCI to the extent there's an amount in there. So in this case of that impairment, 82,500 can go through here. That would eliminate the revaluation reserve to zero, but we've still got some more of the impairment. You can see here that we've got 195k. So we're going to have to credit PPE to get the asset down to its fair value, which we've done. So you're going to credit the PPE, just like we did with an impairment. And the difference here is, of course, we've got an amount in the revaluation reserve. So this impairment expense can firstly be charged to the revaluation reserve. And we said there that would be the 82,500 because that's how much was there. And then the remainder will go to the P&L. Now, if there wasn't an amount in the revaluation reserve, then it would all just go to the P&L. So you can see here, because that asset had previously been revalued upwards, then there's an amount which can go through the OCI because there's an amount in the revaluation reserve. So only this amount of the impairment would go through here. If that asset had never been previously revalued upwards, then again, you're always going to have to reduce the asset to its fair value, but then the debit would all go to the P&L. Like this impairment here, credit PPE all goes to the P&L because that asset had never previously been revalued upwards. But if that asset had previously been revalued upwards, then the amount can go through the OCI first of all. And that's the case whether you're looking at a downwards revaluation, so you're just doing your annual downwards revaluation under the revaluation model, or there's an indicator of an impairment, so you're doing an impairment test, or if the asset is held for sale, because you're really doing the same thing every time. You're remeasuring the asset, and if it's gone down in value, then that's an expense, and that expense has to go somewhere. But if you've got an amount in the revaluation reserve, and the reason you'd have that is because the asset's previously been revalued upwards through OCI, then that can go, the impairment, the downwards revaluation, essentially kind of the same thing really, is recorded through OCI, and only the remainder goes through the P&L. But you can see now that's the same with all of them. So you can appreciate the consistency here, and actually there's a huge amount of overlap, and it's essentially the same accounting treatment. Assets gone down in value, usually goes to the P&L, unless asset has previously gone up in value, in which case it can go through the OCI first of all, to the extent there's an amount in the revaluation reserve. that kind of ties in with what we've looked before at the revaluation model and impairments. So we can see here, that's how we account for this asset. So that's what we kind of do initially, and therefore that asset would be impaired. So therefore we do this before we reclassify it. So this is a bit fiddly, this bit, because we've said we firstly remeasure it to fair value. So like a usual revaluation under the revaluation model. But when you actually take it out of PPE and put it in assets held for sale, you measure it at the lower of its carrying amount, which is carrying amount is this, and fair value minus cost to sell. So of course, its carrying amount is its fair value because we've just remeasured it. So therefore, if you reclassify it, take it out of here and put it in here at fair value minus cost to sell, the difference, of course, is going to be the cost to sell. So we know what its fair value is. So it's fair value minus its cost to sell. So we're told that the cost to sell are 3%. So therefore it's fair value minus cost to sell. A shortcut way would be to do it like this, just take 97%. But you could do it the long way, the 165 minus the 3% and then get down to it there. So therefore that's its fair value minus cost to sell. So in assets held for sale, it's presented at this amount. Clearly, what we're doing here is we're going to credit PPE to take it out of PPE. So we're removing this asset out of PPE entirely. It's in PPE at this amount. We record it in assets held for sale at fair value minus cost to sell, and therefore, the asset's fallen in value, so that's effectively an impairment, and of course the impairment equals, the cost to sell, because it was measured at fair value, and now it's measured at fair value minus cost to sell, so the difference, of course, is the cost to sell. Now, if it was measured under cost model, you wouldn't have to do the first step of this revaluation, so you just take, the carrying amount at whatever it is and then compare it with fair value minus cost to sell. Just if it's under the revaluation model, you have this first step first of all. So therefore we've worked out there, what that impairment would be. So we've kind of got our workings there, so we could copy those over. So we've said up here, measured at lower of these two under the revaluation model, it's this. So you could possibly add on a few extra points, but this would probably be enough. I think we had, was it 32 marks? We had kind of 5 issues. So about kind of 6 points per issue. That's plenty here to get us to the full marks. We've got the journal entries there. So we could just go and drop our numbers into here. Hopefully you're starting to see now why it's easier to do this one note at a time. Immediately after doing the note, I wouldn't want to have to go back through all of these workings. So we said here that we've got, so the asset's going to firstly reduce by the 195. So the asset's going to reduce by the 195, but only 112 is going through the P&L. So we're going to have this amount going through the P&L. And then we're going to kind of have that additional impairment, which does kind of reduce total assets overall, because we're taking it out of PPE and then we're going to assets held for sale is slightly lower. To just show that as a net, really. I mean, you could show it as the PPE reducing and then assets held for sale increasing, but the difference is just this, of course, and then that impairment is recorded in the P&L. So again, all of the movement in the asset is recorded in the P&L, as we've said before. When we revalued upwards, of course, some of it went through OCI here, so it didn't impact profit. Now we're revaluating downwards, not all of it is impacting profit because some of it's going through the OCI. So then we'd have that note, done with in its entirety there. So that's assets held for sale. We could mention as well, no further depreciation on the asset. We've mentioned that there already. So this does also time with discontinued operations. So this is more from a reporting point of view from the P&L. But if it's a separate geographical area, so maybe warranting is a separate geographical area perhaps, or if it's like a separate market, and they can separate financial information from the rest of the business. So if Warrington was kind of like its own business unit, maybe it's got its own customers, its own sales rooms, things like that, and therefore it had its own revenue and its own costs and its own assets and its own liabilities, then it's not a subsidiary company, it's part of the same company. It's not as though it's an entirely separate company. It's part of one company. It's all part of Hillington Limited. But if it's a separate division, then it could be that the profits and losses, including the impairment on remeasuring those assets down, would all be presented in discontinued operations. So you take the revenue out of revenue and you take the distribution expenses out of distribution, you'd lump them all together as a single profit figure here. So that would be from a P&L point of view. We're focusing on assets here because it applies, we've got assets held for sale. We've looked at those conditions there. We've got the conditions as well for it to be treated as a discontinued operation. So we present them as a single line. But in the FAR exam, they'll tell you whether it constitutes a discontinued operation. So they'll tell you if the IFRS 5 criteria for a discontinued operation are met. Wasn't mentioned here in this question, and we are just told, I think it's just a manufacturing operation, so it doesn't appear as though it's a kind of a separate division. It's not as though they've got their separate Warrington customers, and maybe they sell a certain type of product to them, which is different from the Manchester division. Doesn't sound as though it's kind of a separate division. It's just perhaps a manufacturing, and that's all they do, and then they supply the showrooms. We don't know the exact nature of the business, but they don't tell you that the conditions are met here, and that's what you need to know in the FAR exam. So again, you can see we're going through like the life cycle of an asset here. We said, can you recognize an asset initially, and if so, which amounts can be capitalized when you first buy that asset? What do you recognize? How do you account for it going forward? Cost model or revaluation model. What happens later on in the asset's life when it becomes damaged, and then you have to write it down? How do you deal with the impairment? We then thought, you've made a decision to sell the asset. You haven't sold it yet, but you've made a decision to sell it. So how do we deal with that? So you, at that point now, you decided to get rid of the asset. And then what happens when you do eventually sell it? So you actually sell the asset. Now this is kind of quite logical when you think about accounting. If you sell an asset, whenever you've got cash, it's quite easy to do the first entry, because did you receive cash or did you pay cash out? So if you're selling an asset, you receive cash, debit cash. If you sold an asset, you have to de-recognize that asset. If you sell it, clearly you no longer control it. So therefore you have to take it off the SFP. So you'd remove that asset from the SFP. So you'd credit that asset to take it off the SFP. And then the difference between what you sell it for and what you had it for on your SFP, so that's effectively what you're saying the asset's worth on your statement of financial position. If you sell it for more than that, clearly you've made a profit. If you sell it for less than that, you've made a loss. And you can think about this from the double entry. This is the cash you've received, so debit cash, credit asset. Well, if you sold it for more than that, you need another credit to balance the entry, and therefore credit P&L. If you sold it for less than that, then the cash will be less than the carrying amount. So you need another debit, and therefore debit in the P&L, of course, is a loss. It's kind of quite straightforward, really. Disposal is fairly easy to deal with. So of course, with that asset held for sale, they've got it in assets held for sale. When they eventually sell it, they'll debit cash, credit asset. The difference is a profit or loss on disposal. So we can see here, 30th of August, so that's 4 months before the year end, sold a piece of equipment. So again, looking at PPE, proceeds of 1250 were credited to admin expenses. So we'd usually work out the profit or loss on disposal, wouldn't just credit them in the P&L. So the equipment cost this on the 1st of June X1. So you can see this is going to be a bit more tricky with the dates. Had a useful life of 4 years. So again, they haven't just told us what the carrying amount is. We're going to have to work that out. They continue to depreciate the equipment, and the carrying amount was included in PPE at the year end. Well, that's not right because they sold it here. So that's definitely wrong. So we can definitely point out the treatment's wrong there. So again, you might be thinking, oh, how am I going to work out the depreciation to get to the carrying amount? It's gone to admin expenses, but the profit goes to admin expenses. So is, some of that right? Again, all of your, your mind might be racing through all of these different things, but just, kind of step back, think what's the relevant part of the standard when we're looking at disposals. So you could say, under IS 16, when asset sold, company no longer controls asset, so needs to be de-recognized. Okay, so de-recognized from the SFP, no longer shown as an asset, and they've continued to show it as an asset. So clearly this part of the standard is very relevant here. And then we could say, difference between, carrying amount at date of disposal and proceeds is, a profit or loss on disposal. So again, all of these little abbreviations here and there save you time. And these are all, perfectly understandable to the examiners and commonly used in practice. So therefore, we know the treatments. We're saying that they no longer controlled it, so the asset needs to be de-recognized. So now we can apply it to the scenario. So we can say asset should be removed from SFP on 30th of August X2 because H no longer controls asset. Maybe even make it a bit more specific, equipment from this date. So that's quite straightforward. So we could say as well, asset, as no asset recognized, as no asset recognized, no further depreciation. So that's the other issue we've got. They haven't dealt with the profit or loss or disposal correctly, but it sounds as though they have continued to depreciate the asset. So then maybe we can start thinking about the numbers. We've kind of set ourselves up quite nicely here. We know that a profit or loss on disposal should be recognized. So proceeds, minus carrying amount, profit or loss on disposal. Now just remember this kind of basic, remember how I just explained that to you, to receive the cash, you get rid of the asset, the difference is a profit or loss on disposal, the difference between what you sell it for and what you've got its value at on your SFP is a profit or loss on disposal. Makes sense. You sell something which is worth this, the difference is a profit or loss on disposal. And it works with a double entry as well, debit cash, credit PPE. So the difference will give you a profit or loss on disposal. And when we come on to look at groups, when we look at disposal of a subsidiary, we follow the same principles here. So really important you kind of understand kind of conceptually what we're doing here as well. So probably start with kind of the easy number. We know the proceeds with this. So we've got the proceeds here. So the carrying amount is going to need a bit of working out, but just as we've done before, we know what the asset cost originally. So again, this is probably an area where you could make kind of a small mistake, a bit of getting the pro rating wrong or something like that. Very understandable mistake to make. Still get full marks though. So the depreciation, so over 4 years. Okay, so that's quite easy. So actually the number overall very easy. We're not told about a residual amount. So we're told what the depreciation would be per annum. So we're told it's got a useful life of 4 years. So therefore we're going to have depreciation of this per annum. So then we can work out how long should it have been depreciated for. Well, you can see that they had it for 1 year and 3 months. So therefore you'd have a year's worth of depreciation and 3 months. So you could do it like, the long way around where you do divide by 12, multiplied by 3. But obviously 3 months is a quarter of a year. So you could do it like that as well. So therefore you can see that we'd have the depreciation and that would get us down to our carrying amount. They had the asset from this date, presumably when it was ready for use. And therefore they would have depreciated it for 1 year plus June X2, July X2, and August X2, minus a day, but always round it to the nearest month. So therefore, you can see you've got the proceeds, minus the carrying amount. You can see they'll end up with a loss on disposal. So therefore, they would end up with a loss on disposal here, and that would be recorded, in the P&L. So therefore, we said, they should recognise a profit or loss on disposal. So we've done that bit, first of all. So that's what should have been recorded. Now they have already recorded the proceeds, so therefore you can see that what they'd be left with is a remaining debit, and therefore that would be a loss in the P&L. Now what we have been told is they've recorded the proceeds in the P&L. So this is what should have gone in the P&L. So that by recording the proceeds in the P&L, what they've done is recorded a profit of this, but they should have had a loss of this. And therefore you can see what we would need to do in order to get the P&L back to the correct position. We'd have to reduce the P&L. So therefore we'd have to have an additional loss of this. We'd have to kind of debit the P&L of this. Another way you can think about this is they've done debit proceeds, credit P&L, but the bit they haven't done is recorded this amount in the P&L, kind of de-recognizing the asset to kind of net that off to get the profit or loss on disposal. Maybe this way is the easiest way to think about it. Now they've effectively recorded a profit of this because they've recorded this in the P&L. This is a loss they should have ended up with. So this is what we're going to need to do to the P&L to get it back in the correct position. So you see what they have done, in the P&L is credit the P&L of this. What they should have done is debit the P&L of this. And therefore to kind of get that in the right position, we need to kind of get rid of that credit and have this debit in there as well, which is where you get to the 2750. So you think, what have they done? What should they have done? And therefore, what do we need to do to correct it? So we're saying the entry is, debit P&L. Well, what's the other side of that entry? Well, the other thing that they didn't do was to reduce the value of the PPE. So they didn't take out the value of the PPE. So it's debit P&L, but it's also credit PPE because they haven't de-recognized the PPE. So a bit of a kind of a long-winded explanation there, but I want you to kind of fully understand what we're doing here. So actually kind of a simple issue, but the adjustment there was quite tricky. So you could kind of start with, that bit, you could kind of copy over your workings, probably should show them all really. I think, you might get credit for, should show everything in case there's something kind of in here which kind of gets you credit as well. And maybe if you've kind of got a small mistake in your depreciation calculation, like number of months or something like that, you can see you'd still get the follow through marks there. And I'll show why any small mistakes in that won't matter when we look at kind of the overall marks. So the other issue that we kind of had here, so you may have kind of left it at that and thought, okay, well, I've done it here, that's correct. The other issue that we had was, remember, they continue to depreciate the asset. So therefore, they've had some extra depreciation going through the P&L. So therefore, they've continued to depreciate it for the last 4 months of the year. So therefore, we're going to have 4 months of depreciation, which have been going through the P&L. So they've recorded this as depreciation. So they would have done debit, P&L, credit, PPE. They would have carried on reducing that amount. But therefore, we wouldn't record that in the P&L. So therefore, that would have to be taken out of the P&L. And of course, it'd be like a negative carrying amount on the PPE once you've disposed of it. So therefore, we need to kind of reverse that. So credit P&L and debit PPE. So they would have continued to reduce the value of the PPE. But of course, that PPE wouldn't even be recorded now from that date. So we've said here that under IAS 16, they no longer own the asset. Difference between proceeds and its carrying amount is a profit or loss on disposal. Asset should be removed from the SFP on this date because they no longer control it. No further depreciation. So kind of this is the key entry here to correct that profit. So therefore we could go and kind of drop that number on first of all. So the profit needs to be reduced, as does the PPE. But then we could say, explain why what they've done is incorrect when they've done something incorrect. Incorrect to continue, depreciating asset. So need to reverse depreciation charged to P&L. And that's that bit that we've just worked out at the bottom here. So you can see here that we would just increase the profit there for that 333. Just make sure we kind of get this the right way around, because I think most other things have reduced it. So of course they continue kind of depreciating that asset more than it needed to be. So we kind of have to increase the asset, back up, because the carrying amount that they've got it at isn't at its kind of disposal date. They carried on depreciating it, so it's kind of even lower. So if you kind of took this out of the PPE, we'd end up with like a negative amount because its carrying amount was even lower than that. So it's kind of almost getting rid of that negative amount. Or you could think of it as, the PPE at the year end isn't at its date of disposal carrying amount, it's at the year end carrying amount, because they continue to depreciate it. So we need to kind of get it back up to what it was at the date of disposal before that kind of additional depreciation. Again, that's probably quite a tricky point, I think, to get your head around, but if you played around with the numbers, you'd kind of see how that works. But again, plenty of easy marks here on the way. So you can see here, for each of these notes, we've used the same exam technique. So relevant parts of the relevant standard, apply it to the scenario, calculate the numbers, including journals, if we need to, explaining if they've done something incorrect, saying why it's incorrect, and then immediately after, for each issue, overlaying the numbers so that we can get to a revised profit figure. And then you can just sum these up. So the profit and the assets, you can sum these up, and therefore you can get to your revised totals. And then you can kind of just copy those over for the next part. So you could have a quick sense check through, just make sure you kind of got all of the signage right and you've included everything. But you can hopefully see now why that's so much easier to do it like that, putting them on one at a time as you go through them, because otherwise, if you did all your explaining, so issue 1, 2, 3, 4, and 5, imagine if we did all of this explaining for all of these 5 issues, and then we look here and think, oh, so what do we need to do for the second part? Oh, we need to redraft profit and total assets. So you'd start with the draft numbers, and then you're going to have to go back through all of your workings, trying to work out exactly what impacted profit and what impacted assets. And, for some of them, okay, maybe that's not too difficult. But, some of these other ones, you'd have to go back through when we did, the impairment, did any of it go to OCI? With the reclassification, is it this journal or this journal? And then it would just take so long to have to go back through it all. You probably wouldn't get it all correct as well. So you'd drop marks and you'd lose time, which is basically the same as dropping marks if it means you can't complete the rest of the paper. So it's much quicker overall if you explain the treatment, take it one issue at a time. So we can number these up. Issue 1, relevant parts of the standard, apply it to the scenario, calculate the numbers, journal entries, and then immediately after include any impact that this issue has on the draft figures that you need to do for the next part. And then on to issue 2, same thing. Relevant parts of the standard, apply it to scenario, numbers, journals, overlay it here. Now you can see that some notes were easier than others. Some notes were kind of quicker than others. We obviously got quicker because I'd already explained the exam technique. But you can see some notes will be easier than others. Some parts in the question will be easier than others. Some bits are really hard. I think that bit was quite hard. In this bit, some of the numbers were quite tricky. Maybe get into kind of even this entry was a bit difficult, perhaps. So maybe you didn't get that. Maybe you didn't get this bit. Possibly, some of this impairment bit here, maybe that was difficult. Maybe you kind of didn't get that. Most of the narrative points were quite easy if you know the knowledge. So if you've got the knowledge, then the narrative bits were quite easy. The impairment was fairly straightforward. The revaluation, this bit, as I said, you probably wouldn't have mentioned that. That might be quite difficult to get in. So there'd be quite a few hard marks on there. Maybe some notes are just inherently harder than others. Maybe financial instruments, for example, students tend to find that quite hard, although I'll make it very clear kind of how you can make that a lot easier in the exam. But, you can see here, some notes will be harder than others, but the beauty of this question is that there will be more available marks than maximum marks. So it might say 32 here, But you can see here that, so 32 on, 5 issues is around, 6 marks per issue. But you can see I've got much more than 6 points here. And that's why there'll be headroom marks. They might have as many, perhaps as 50 marks available for this question. So therefore, there's kind of like 50 points, possibly more, that you could put in order to score marks. So as I said before, you don't need to get every single point correct to get full marks. If I take this point out and take some of these hard points out, there'll still be 32 marks here. So you don't even need them to get to full marks. And that's what's quite different between this question and question 1, prepare the single entity financial statements, or whenever you're preparing financial statements, there tends to be less headroom marks. So it's much harder to get full marks on those questions because you do have to get almost everything absolutely correct. Whereas this question is much more forgiving because you don't need to get everything correct in order to get full marks. You can get quite a bit wrong or even miss bits out and still get full marks. So this exam technique will make sure you kind of get the easy marks with the relevant parts of the standard. Remember, it's the relevant parts of the standard, not just copying out lots of information from the standard from the open book. So you're using a skill here by selectively having the relevant parts of the standard, applying it to the scenario and kind of getting the main easy numbers and doing the journals and overlaying the numbers. They're kind of, if you do that for each issue, you should get full marks, and you can even skip the harder bits. If you come on to issue 3 and it's really hard, kind of maybe do relevant bit of the standard, apply it, have a quick go at the numbers and move on. Because if that's really hard, that'll be kind of the harder bit of the question, and just make sure you attempt all the issues so that you can get the easy and medium marks on each issue. Grab the low-hanging fruit. On this question, there'll be easy, medium, and hard marks. You want to get all the easy and the medium marks. An easy mark is worth a mark. A hard mark is worth a mark. So get the, make sure you get all the easy ones. Grab that low-hanging fruit. That's what you want to be, doing here. Get the easy, but it's a really good exam strategy, a really good exam technique. And you get that by kind of following this technique, making sure you attempt every issue, making sure that you overlay the numbers, because actually overlaying the numbers is quite easy. Where it gets hard is if you're having to go back through your answer. If you said, debit P&L, credit PPE, reducing profit and reducing assets is easy. So just, make sure you do it then, because that's the quickest way to do it. So being efficient with time is also kind of a key exam skill to really getting yourself up to those top marks in the exam. So far, we've looked at PPE, property, plant, and equipment, and these are tangible assets because they are physical assets that can be touched and seen. Now, intangible assets are, of course, assets which aren't tangible and therefore can't be touched and seen. So here we're looking at things like brands, patents, software systems, processes, and goodwill. So goodwill is the general reputation of the business, its network with suppliers, etc. So we can think about whether those assets can be recognized. Now, we've said an asset is a resource, so it's controlled by the company. So these assets like brands and patents, they can be controlled by the company. They might be a result of past events. Perhaps they purchased the brand from somebody else, or perhaps they've kind of built it up themselves, but they've got a legal right to use the brand, so it's got a copyright. And they'll produce future economic benefits because, if you've got a brand which has a lot of value attributable to it, then customers would be prepared to pay additional, and therefore there'll be additional revenues and additional cash inflows arising from the brand. Perhaps the company has a certain software or a certain system, which means it's more efficient and more effective than its competitors. So therefore that could result in increased cash inflows, increased revenues, or possibly reduced outflows, because maybe the software automates processes and therefore kind of reduces the staff cost. So therefore you can see we've got our usual criteria for an asset, but on top of that, the asset has to be identifiable. So it has to be possible selling the asset without selling the whole business. And that's why it can be difficult to recognize internally generated goodwill because you wouldn't be able to sell, the reputation without selling the whole business. Or it could arise from legal rights over the asset, so possibly, something like a brand. Now, when we looked at, PPE, and we didn't also say, how it could be how it needs to be measured reliably, which it does. You must be able to measure the asset reliably, and we've seen several ways in which the asset can be measured. So we've seen cost, we've seen fair value, and we've seen present value. So these are kind of like three ways we've measured PPE, looking at the present value of the cash flows, we're looking at value in use, looking at fair value, what it could be sold for, or its original cost when the asset is first acquired. So again, with intangible assets, to recognize that you have to be able to measure it reliably. If you can't measure it reliably, then what are you going to record in the financial statements? But again, this perhaps throws up more of a complexity with intangible assets, because if it's an asset which has been built up internally, so an internally generated brand, for example, then it would be very difficult to say how much that's cost, because effectively everything the business has ever done has contributed to building up that brand. Unlike when we think about internally generated PPE, like when we saw that example earlier, when they constructed the specialist piece of plant, you can clearly see all the costs that went into building the plant, the materials, the labor, etc. But when it's something like a brand, almost everything the company's ever done, all of its marketing activities, all of the services it's provided, all of the feedback it's gathered, all of that's fed into that. So it's quite difficult to kind of trace all of those costs, and not all of them relate to the brand. Some of them do. So it's very difficult to get the cost. So that's another complexity here with intangible assets. So therefore, you wouldn't be able to recognize an internally generated brand. So therefore, internally generated, goodwill, brands, and customer lists, these can't be measured reliably, and therefore they can't be recognized as assets. So therefore, any costs are just expensed to the P&L. So you can kind of see the difficulty there. Now, we're talking here about the single entity financial statements here. So we're looking at a single company, and we're looking here at a single company, and we're saying what can they recognize in terms of their internally generated intangible assets. Now, when we come on to looking at group accounts, we'll see that there are circumstances in where internally generated intangible assets are recognized in the group accounts. We'll kind of come to that separately. So when they're internally developed, so the companies develop them themselves, then we can't recognize them here. However, if they purchase them from somewhere else, so if the company purchases a brand from another company, then you could recognize the brand, because you could get the cost, because they would have paid 50,000 for the brand. If they purchase a customer list, again, you'd have the cost of that asset. Now, if you think about goodwill, could they ever purchase goodwill? Well, let's say that the company purchases some assets from another business, so they purchase the whole business. So let's say that they pay like consideration of 10,000 to buy a business. So not just buying a single asset from another business. Let's say that we're looking at a retailer here, and they identify like a small retailer, maybe just an individual shop that they want to acquire. Now, let's say as part of that, they acquire some PPE, they acquire some inventory, maybe some other assets, receivables, etc. as well. We'll just use a couple here. Now, let's say that the PPE was worth this, and the inventory is worth this. Then you can think, well, what else have they paid for? Why did they pay 10,000? All that was in here, all they purchased was PPE and the inventory. What else did they pay for? Well, we'd assume that they paid for the goodwill of the business, because maybe this business, this store, has a good reputation with its customers. It's a store in the local area, so customers kind of keep coming back. It's got a good reputation, and therefore that business has some goodwill attached to it, and therefore that's what they were paying for. And then you can see they've acquired that goodwill externally, and we can measure it because they paid a price for it. If they pay 10,000 and the PPE is worth this, the inventory is worth this, then the goodwill must be worth this. And therefore that's when it could be recognized in the single entity accounts. And we'll see something similar as well when we look at, group accounts, a similar principle of looking at what did you pay for the other assets, and therefore anything over and above that must have been you paying for the goodwill. And now we can measure that goodwill reliably and we can recognize that on the SFP. But from a single entity point of view, they'd have to be acquiring like an unincorporated business. So they're buying a series of assets, and the difference between what they pay for those assets and the value of those assets is a goodwill asset. So you'd only see that in single entity accounts if they've bought an unincorporated business, or a sole trader, or a partnership. So therefore you can start to see some of the complexity here, because it's difficult to measure some intangible assets reliably, and some may not be separable as well. So there's initial bit more complexity around, can you recognize the asset or not? But once you can, then just like PPE, the cost of the assets, if it's purchased from an external party, as we just said there, you just got the cost of the asset. And any other costs which are directly attributable to bringing that asset into use can be capitalized as well. So if there were some, like legal fees that, had to be incurred, or any other costs which were kind of directly attributable to acquiring, those assets, then, they could be capitalized as well. So just as we kind of said earlier, very similar to, PPE, any directly attributable costs, such as, legal fees, advisor fees that had to be incurred in order to acquire it, would all be included. And again, if you're developing an asset, then again, the interest costs on the loans could also be capitalized in that as well, just like PPE. So we'll see the treatment is very similar. There's just, because of the nature of them, there's just a few additional complexities. So when we're looking at, when it's purchased from an external party, that's quite straightforward. You can measure it reliably. If it meets the definition of an asset, then it can be recognized. So when we start to develop them internally, with PPE, we looked at constructing an asset. So with intangible assets, these are, development costs. So the cost of developing a new intangible asset, then a cost can be capitalized, but if strict conditions are met. So again, this is why the open book can be useful, because it just reminds you of those conditions. But we've got future economic benefits being probable. Is it technically feasible to complete the asset? Do they intend to complete it? Do they have the ability to use it or sell it? And can it be measured reliably? So if you think about what types of intangible assets might a company be developing, well, it could be doing like a prototype for a new product, for example. It could be like a new software systems. So if you think about, a common company, maybe someone like a tech company, maybe like Apple, for example, there'll be like an initial research phase where they'll do some initial research to consider whether they can kind of develop a chip of a certain size to develop a new type of iPhone. So there'll be all these initial research costs that they do, where they're just kind of more scientific, technological research. But at that point, it might not be clear whether it's technically feasible to develop this new prototype phone. It might not be clear whether they'll be able to sell it at a profit. So therefore, these conditions wouldn't be met, and therefore those costs would be expensed. So they'd be expensed to the P&L when it's just research costs, because it wouldn't be probable that there'd be future economic benefits, and it might not be technically feasible to complete it. But once they can see actually this is feasible to turn this into a new iPhone that will sell at a profit, it's possible to do it, because that's what our tech teams have said. We intend to complete it. We're going to sell the product, and we're going to use it to sell, create a mass market for it. We can measure, all the costs reliably, and then those costs can be capitalized. So again, rather than expensing those, to the P&L, you can then start to capitalize those costs. Well, you have to capitalize those costs. It's not optional. It is optional under UK GAAP, but not under IFRS. So therefore, when it's an internally generated intangible asset, you have to think, is it research or is it, development phase? And therefore, that's why the open book can be useful there. So of course, they're constantly paying out cash, whether it's research or whether it's development. So we're crediting cash or, possibly payables. But again, we're back to that issue, that decision. Can you capitalize it as part of an asset, or do you have to expense it? Well, if it's research, it gets expensed. Once you meet the capitalization criteria for development costs, then it gets capitalized, and then you've got an intangible asset which would have to amortize going forward. So you can see initially there's a bit more complexity with intangible assets, because they can't all be measured reliably, so internally generated assets like goodwill, brands, and customer lists. So generally, internally generated intangible assets can't be recognized unless it's development costs, unless there's going to be future economic benefits, they're going to complete the intangible asset, they're going to use it, they're going to sell it, etc. So you need to meet all of those criteria. So things like developing software, developing systems, processes, prototypes, all of those would come in to looking at development costs. And then once you've got your assets, or either you've acquired it externally, so you've got your asset, or you've developed it internally and it's met these strict criteria, of course, you then capitalize these costs. So just like PPE, we're going to have to depreciate them. You've got an asset, you're going to use it over its useful life. So therefore, you have the cost, but it's going to be used over multiple periods to produce future economic benefits. So you have to take the cost and spread it using the accruals concept over the life of the asset. So exactly the same as depreciation. It's just for intangible assets, we call it amortization. So again, there's two models. There's a cost model and there's a revaluation model. Under both, you would just amortize it. So you'd amortize it over its useful life. Again, when it's ready for use. So you can see very similar. When it's ready for use, amortize it over its useful life. Assets of the same class have to follow the same model. So if you're looking at software or licenses, they have to follow the same model. Useful economic life with intangible assets, you might have to think about it a bit more. PPE would only last 5 years and then it's worth nothing. With intangible assets, you could look at it. So if it's a license, legal right to use whatever that license gives you the permission for, possibly expected sales period. If you were looking at software, or if you're looking at the prototype development for the new iPhone, it could be amortized over the sales period, or when technology is expected to change. Again, you review it annually. It's unlikely that there'd be a residual value for an intangible asset because they're so unique. So if you think about the residual amount for like a piece of plant, or possibly even for a building, then that's quite a generic product. So lots of other businesses can use it. It's probably lots of other companies who use the same plant. And obviously lots of businesses use properties. Whereas with intangibles, they're kind of quite unique by their nature. Like things like software systems tend to be a bit more specific for a company, like a prototype. Who else is going to use a prototype for an iPhone other than Apple? No one else will be able to use it. There's also things like brands as well. They're very unique. So if they were acquired externally, it would be quite unusual for them to have a residual amount. And for that same reason, it's difficult to use the revaluation model. While it is possible, if there's like an active market for that specific type of intangible asset, it's quite rare. So it'd be difficult to get a fair value. It'll be difficult to get that fair value for the revaluation model because it's so difficult to kind of value brands. It's not like with property where you could just go and say, okay, well, what's the building next door worth? Or what's the building, down the road worth? Because it's more of a generic product. Intangible assets, like we said, by their very nature are unique. So therefore, there isn't an active market where you can just find identical assets with a value and therefore use that. And then, of course, just like PPE, we go on, the asset could be impaired. But again, you've got its carrying amount. And what we're saying it's impaired is, this is too high. The asset needs to be reduced in value. So, of course, you do the same test, value in use versus its, fair value minus cost to sell. It could be part of, it could be an asset held for sale if they're going to sell it. But again, all of these is quite difficult to get a fair value. And then if they sell it, obviously the difference between the proceeds and the carrying amount, that's just kind of a fundamental accounting principle there. You sell it, you no longer control it, do you recognize it, record the proceeds, difference between proceeds and carrying amount, profit in the P&L. So the accounting treatment is very similar. It's just a different type of asset, very different nature. So there's just a few more complexities there. If you kind of think quite practically about it, it does all make sense. It does make sense why it would be difficult to measure some of these assets because of their nature. There isn't costs which are as directly attributable to them, particularly internally generated ones. You think about the research and development phase. Obviously, the research phase, it's not clear that there'll be future economic benefits, so therefore the definition of an asset isn't met. But when you kind of developing it and it's quite clear there's a market and you've done some like profit forecasts to see that it would be profitable, then you can capitalize those costs. And then you can see why the revaluation model would be difficult to apply, because the assets are unique and therefore getting a fair value is difficult. And if you haven't got a fair value, you can't use the revaluation model. And again, that's why you probably wouldn't have a residual value as well. I mean, some intangible assets, possibly, maybe something like licenses, if there are other licenses being sold in a market for a comparable or ideally identical service or use. So it is possible, but it is much more infrequent. But again, the fundamental counting is the same. You have an asset, you acquire the asset, you capitalize it, then you amortize it, then you get down to your carrying amount. When you dispose of it, you're going to have a profit or loss on disposal. You could possibly revalue it, could possibly be classified as held for sale. But much less likely that they would be selling it because of its uniqueness, but it is possible. But hopefully you can kind of see the overlaps there, both between impairments, which impairment is just really accelerated depreciation, but the revaluation model, when something goes down in value, and impairment, assets held for sale. So you can kind of see the consistency there, the overlap there, how we're following that similar accounting treatment. And then intangibles, what we capitalize initially, directly attributable costs, etc., where it gets expensed to the P&L, things which aren't meeting the definition of an asset, staff costs, they're not controlled, staff aren't controlled by the business, research costs, no future economic benefits, internally generated goodwill, brands can't be measured reliably. So you can see here, it all does kind of come back to, the definition of an asset. Research won't produce future economic benefits because they're just repairing what was already there. Future expenditure, not a past event. So you can kind of bring it all together there at the end. So I think there's really two elements to mastering FAR. First thing you need to do is make sure you understand and memorize the key technical content. So you can see here our materials, our learning notes, summarize the key content. So you've got it in a nice, easy to learn format. So I'd used to test myself. So I think, PPE, what do I know about PPE? And I'd make sure that I can kind of reproduce this from memory. So I'd make sure I understood all these points first of all. And if there's anything you don't understand, you can go to the ICAEW workbook and get a fuller explanation there. But key points, definition of an asset, key points, resource controlled, result of past events, future economic benefits, can be measured reliably. So that would always be the first bit I'd kind of put down. I think, what's the first thing, I know about assets? Well, if you think about assets, what's the key definition first of all? So I'd make sure that I could kind of reproduce that. So I'd keep testing myself so I could kind of memorize those key points, reproduce those first of all. And then I think about it just in a life of an asset. Okay, so a company does acquire an asset. What do we recognize first of all? So initially, you can capitalize the cost of the asset and any directly attributable costs. And then I might think, okay, well, which costs can't be capitalized and what can be included. Okay, interest is included there. So I just make sure I can kind of reproduce these key points, because this is all you need to know, for the exam. And I think subsequently, how do we account for PPE? Okay, so there's cost model and there's revaluation model. So I think, cost, and then I think revaluation, great. And now what do I know about both of those? Well, asset uplifted to fair value. So maybe asset up, to fair value, and then you could think, additional depreciation, and the cost model isn't remeasured, asset depreciated for ready for use, that kind of applies to both. So I just keep kind of testing myself to make sure I've got these key points in my head. So I open a blank page and then just kind of reproduce these key points. So I've got them kind of ingrained into my brain. And then do it for all of them. I mean, there isn't a huge amount here. There's, like 2.5 pages of content. It's all in short note form. There isn't much at all that really you need to know. So just making sure that you kind of learn and memorize those key points. But the most important thing is to straight after go and do some exam questions. One, because you're actively testing yourself. I mean, you're actively testing yourself here when you're reproducing the key content, you're actively testing yourself because you're forcing your brain to recall that information you memorize. And that's really kind of reinforces the learning process. So you're really kind of almost struggling. You're struggling to get that information kind of back out of your brain, and you'll be frustrated when you can't remember something. And then, you'll look back, or you'll do as much as you can, and then you look back and you think, oh, I forgot that, what value in use was, or something like that. And then you just kind of refresh yourself and you'll remember it for next time. And then you try and do it again and reproduce it again. And that time, you'll remember it. So it's more active. You're kind of forcing your brain to kind of recall that information. Now, once you've done that and you've kind of got this information committed to your memory, what's really important is that you actively test yourself even more by working through some questions. Now, these are the best types of questions to do because these are the questions that you're going to be asked on exam day. What better type of question to practice than a question that's in an exam format, which is a question, if you're using a question bank, it's written by the people who are testing you, the examiners, because one, it's forcing you to actively recall this key content you need to know, but it's making you kind of work on your exam technique as well, because you're having to answer it in an exam format. So you're testing yourself on that knowledge, but you're also doing it in an exam scenario. So you'll start to see the types of points that the examiners include. There's almost the little tricks that they have in there, or the difficult bits like, pro-rating and things like that, or the common mistakes that the accountant makes, didn't depreciate it because staff are still being trained. And you might see that come up a few times. So they're testing you. Do you know the asset's depreciated when it's ready for use? So again, by doing it in a real exam scenario, you are really kind of testing yourself in that realistic experience, that realistic scenario, that realistic environment that you're going to be tested in. And you're not just getting benefit from answering questions and testing that knowledge, but you're also doing it, so you start to see the familiarity in the questions. You'll start to see, the same points come up time and time again. You'll work on your exam techniques. So you get these kind of easy marks first of all, then apply it and then do the numbers. You'll start to see your own weaknesses, the bits that you tend to kind of miss out on. And then you can kind of go back to your notes and think, oh, why wasn't, the general admin, capitalized? Oh yeah, because it's not directly attributable. And then you kind of test yourself again on it, and you'll remember it next time. So it's the best way to test yourself, and again, practicing that exam technique of then bringing these numbers onto the revised profit figure immediately after. So after doing an individual topic, like assets in this example, but we'll do all of the other topics in the later classes. Once going through an individual topic, it's really important you go away and practice lots of questions on it. So memorize the key points of that topic, which there isn't, that many. I mean, for some topics, it's really small, provisions, what's there, a couple of pages there on, provisions, and these are all in note form as well. It's not even a couple of pages. It's what page and a bit in note form. There really isn't that much content to learn for each topic, but what's really important is you go away and practice several questions, one after the other. So for assets, after you've been through the notes, you can go to the latest version of our master plan, and we've got all the questions listed out. So usually, in the question, you might only have one or two of the issues on assets. We focus on assets here, so we've kind of created a question which is all on assets. You won't get this in the exam. You might get issue 1 and issue 4 on assets, but this might be on revenue. This might be on financial instruments. You have to jump from topic to topic, but you can still do that. You can go to the questions and you can still just work through the issues which have assets on them. So you just go to the question and do the one which is on assets. And just do several of them one after the other. You don't have to do them all. You could just do like a few for now and then come back to it in your study plan, which we'll talk about after. But you go through your study plan, you'll do some assets now. You think, okay, I'm really comfortable with assets. I've done 4 or 5 questions. I'm really got the hang of them now. I'm really getting all of the marks, looking into the answer and seeing, have you got the points? Now, the answers in the back are far too detailed. You can't get all of that down in the exam time. So they're not model answers. They're really good like tuition resource because they're full comprehensive explanations, but you have to kind of do your answers like this because of the time pressure. So short, concise writing style. But you can go through and, if you've got a point, just kind of assume, what kind of 1 mark per point, and you can kind of see how those marks will rack up. So if your point is correct and valid, then, give yourself the mark. So you can go through and do a few questions, and if you think, well, I'm getting kind of like full marks on all these assets questions, you think, great, I've mastered assets, and then you can move on to, the next topic, and then you can start to move on to, revenue, and then you can move on to provisions, and just one at a time. So revenue, watch the video. Let me explain the key content that you need to understand in a nice, easy, straightforward way. You understand it, you go away, make sure that you've kind of understood these key points, you can reproduce them. So using that same, active memory kind of approach to learn that key content. So make sure you've kind of committed that to your memory, and then go away and practice questions and answer them in the same way I did, and just keep working on that exam technique, starting with those explain questions. So we'll kind of go through each topic one by one, mastering each one at a time. Makes it much more manageable by breaking it down like this. You can just master them one at a time, and it enables you to be more flexible with your study planning as well. So if you only do have an hour before work, or half an hour before work, do a small topic like provisions. Watch the video before work, lunchtime. So you'd have seen me before work, explain the content and work through some questions. Lunchtime, you can do a question. After work, you can do a couple more questions. So you can kind of see how by breaking it down, not only does it make it more manageable in terms of like overload on your brain, but also you can do small topics in small slots. You can be more effective overall with your time. So when you only do have half an hour or an hour, you can still get something productive done because it's all now in smaller chunks. So we'll just keep going through all of the explain questions and all of the topics. Then we'll look at some question ones where we'll work through, question one, turn the trial balance into a set of financial statements. So there's an optimal exam technique for that you should use to be really quick and make sure you get all the adjustments on. Then we'll move on to groups and look at every type of question, so SFP, P&L, statement of changes in equity, disposals, acquisitions during the year, every type of group scenario that we can get. And then we'll look at cash flow statements. And then we'll look at the smaller questions as well. So you'll get a question on the conceptual framework, UK GAAP differences and ethics. But again, there's a certain exam technique you should use for each of these types of questions. So we've looked at the explain questions today. I've showed the exam technique to use in order for you to kind of get your full marks there. But we'll kind of do that for every single question in the FAR exam. So, the real key with FAR is breaking it down into the different kind of question types and then dividing it down into topics and just mastering each topic one at a time. Understanding the technical content, and I'll explain that to you in a nice, easy to understand way as we have in this class. And then I'll immediately after work through some exam questions to show you the exam technique to use, to show you that the most efficient exam technique so you can get as many marks as possible in as little time as possible. That's what, exam technique is fundamentally about. Getting as many marks in as little time as possible so you can answer every question, get the easy and medium marks as a minimum on each question, but even the hard marks aren't too difficult. And it will really kind of get you up, way into comfortable passing grade, certainly, higher than that as well. And then all you need to do is make sure you've memorized that key technical content and then practice the questions which are listed in the master plan. So if you head over to the ACA Masters website, we've got plenty of other free useful resources on here. So if you go to the financial accounting and reporting page, you can find some recent feedback from students. We've had some great results here. Students going from 19% to 70%. We've had students getting 91% after failing previously. So you can really see the benefit that the course has, the benefit that this focus on exam technique has. We've had some prize winners as well. So we've had 89% despite not previously having a good understanding. So breaking it down by topic, really helping performing well, in the exam. But yeah, as I said, we've had prize winners as well for FAR. We've had someone coming out of the exam saying, not only did I feel as though I passed, I knew that I had truly aced the exam. So, you know, be able to come out of the exam with a lot of confidence, you know, not only going into the exam with confidence, but coming out with it with such confidence, you know, must be nice, not having that dread for 5 or 6 weeks waiting for results, you know, knowing that you've passed because you've done so well, in the questions, because your exam technique is so refined. So if you head to the video course section of our website, we have another class here, so another one which is available. So you can subscribe to the full course here. So that's so you can get all of the classes in the course. We go through every topic, every question type there. So you can go through those. You can even rent individual videos if that's what you prefer. Or you can get the full course and learn how to master every type of FAR question. We also have our live course available. So that's held in the run up to each exam. And then the study materials I've been demonstrating today. So you can get these here. So that's what we've been using today. So that includes like the technical notes and the master plan as well. So all of that is available on our website. If you head over to the exam tips page, we've also got some useful videos on FAR. So we've got some videos here on how to build a study plan. So I know some of you are quite unsure about, you know, how you should structure your revision plan, you know, which topics you should focus on, how you should allocate your time, etc. So I've made a video on there that hopefully you'd find kind of quite useful, as well as some exam day tips as well. We've got some recordings as well from some recent free events we've run in collaboration with some of the ICAEW student societies. So these are available to ICAEW students. So we've made this content available free of charge for you to kind of help you with your studying and preparation. Obviously, the full course gives you, you know, the most benefits. You'll see me going through every topic, but we do appreciate that not everybody has the resources to subscribe to the, you know, full course or to attend the live course. So we've included those exam tips there as well. As well as just for everyone, really, just to kind of give you a bit of a steer on how you should, you know, approach these exams. Obviously, I've been through the exams, you know, with some success, and, you know, I really do feel as though that, you know, exam technique is such a critical component to my success and the success of my students. You know, I've had several prize winners as well. And I think exam technique is absolutely fundamental, and that's why I kind of focus kind of so much on that and teaching you the key content. I'll teach you the key content, but in a much more easier to understand way. I think sometimes some of the explanations in other resources can really overcomplicate things. So we just try to keep it nice and simple, but then really focusing and drilling in on that exam technique. So now I really hope that you have found this class useful and that you'd be interested in using our other resources. And we are planning to release some additional YouTube videos in the future. So if you would like us to do this, then please like the video and subscribe to the channel. The more likes and subscriptions we get, the more we will post on YouTube. So if you'd like to see more of this content made available for free, then please like and subscribe. So thanks very much for joining the class. Hope you're kind of quite clear on what you need to be doing going forward, and I wish you all the best for your future exam preparations.